but it at least gives you a more recent look than that year-over-year number, which tends to be a little bit smoother. But at the end of the day, this is just one data point on wages, and arguably it's not the most important. It is the most timely, but I think we see the Fed and other policymakers give much more weight to the employment cost numbers.
We're swapping questions this morning, Sarah. Tom wants to know about the quirks of December. Talk to us about the quirks of December. Just how reliable is that jobless claims number we got in the last 24 hours? How reliable would this data be a little bit later this morning?
Yeah, so with the jobless claims number, so of course seasonality is a huge issue this time of year, but even when you look at the non-seasonally adjusted numbers, they're running comfortably below the levels that we saw in 2017, 2018, 2019. And so I think it's pretty clear that layoffs remain low, but where we get concerned about is, well, what's happening on the other side? What's happening with those new hires? And we saw that with the JOLTS report, those gross hires coming down to the lowest rate since 2014. So, well, the jobless claims numbers, I think, are genuinely showing low layoffs, that there's still some concerns about the pace of hiring. You ask about some of the quirks of December particularly, I think you will still get likely somewhat of a boost from the end of strikes coming from Mack Trucks, the casino strike in Detroit, and so you're still seeing some noise with that. Seasonals around holiday hiring is also can also be pretty difficult this time of year, so there's still going to be some noise in the December payroll numbers as well.
That said, Sarah, is there going to be anything that could give credence from an economic perspective to Fed rate cuts in March?
Well, I think if you see overall a faster weakening in terms of the payroll numbers, so if you get something, comfortably below consensus, if you see also, I think those wage numbers also indicating that those labor costs continue to slow on trend, I think maybe that could boost the possibility. But I think when you look at where the Fed is right now, there really isn't that consensus for a March rate cut, and so I think that still looks a bit early in our view. If you look at some of the major data points, including today, we'll get three payrolls reports, 3 CPI, but only 2 PCE reports. And so I think there's still some concern that, well, we've seen a lot of progress on inflation. Can that be sustained?
I remember last year, Sarah, when people were laughing at the Fed's projections of where unemployment rates were going to end up, even with this disinflation. And actually, those unemployment rates were too high, given what we've seen so far. And I'm just wondering whether you buy into this idea that we could end up with a 4.1% unemployment rate, which is up just a touch from where we are now, and get inflation back down to 2% by the end of this year.
So we're a little bit more pessimistic on the unemployment side. So we think unemployment will be closer to 4.5% by the end of the year. But we also think that inflation is probably going to be a bit lower than what the Fed expects. So closer to about 2.2% by the end of next year. So I think you're still getting some benefits of just the normalization of supply chains, the housing softness feeding through to the official numbers as well. So that's helping, in addition to, I think, just the broader dampening in the demand picture that we're expecting in the months ahead.
Off the jobs report, what's your GDP call for now, Q4, and also for all of 2024?
Yeah, so for Q4, we're still looking for a pretty marked moderation, so somewhere closer to 1%. And for full year 2024, we're also looking for somewhere closer to 1%, but that's not going to be even throughout the year. So we still have a mild recession in our forecast, where we think there's a good chance that we'll get at least 1, maybe 2 negative quarters around mid-year. So that's weighing down that average that we're expecting for both the fourth quarter and still seeing growth here in Q1.
Sarah, just to recap, just quickly, which month have you got penciled in for that first cut from the Federal Reserve?
So right now we have a June cut, but I think just given that the inflation data has come in a little bit lower than expected, and then I think just the Fed's thinking has changed a little bit. They seem to be more comfortable with not only where rates are now, but where they are beginning to have that conversation around when the Fed, when they do eventually cut. I'd say the risks are probably skewed towards somewhat earlier than that call.
It certainly feels that way. Sarah, thanks for the update. Appreciate it. Happy New Year. Sarah House there of Wells Fargo on the data that comes out in a couple of hours' time later this morning. Payrolls coming up very shortly, and the Federal Reserve. Next move, the call from Wells Fargo, Tom. June, penciling in that first rate cut, but ultimately the risk that it comes sooner. Two things, two reasons. One is the data, but also the Fed's thinking around that data. Tom, things have shifted in the last few months.
Yeah, I think the Fed parlor game's in full swing right now, and you're right, it shifted. And to the point we heard earlier, the revisions today are maybe as important as the actual job statistic, the non-farm payroll statistic that we see. I'm way more focused, John, right now, away from the Fed story towards the real economy story. And for Sarah House to state there a 1% Q4 GDP, that's a tepid statistic. 1% GDP Q4, I don't know what percent of America that puts into agony, but it's a large number.
This at a time when I keep having one eye to this potential supply shock. I mean, how did they respond? I just want to go back to the Maersk story. I keep thinking about it. Maybe it's just because I'm being over dramatic. But to me, the idea that shipping costs are going to increase for the foreseeable future and potentially could increase significantly more as they reroute in this really massive way, you have to pay attention to that. That affects costs of goods, which have been one of the main inputs to disinflation that we've seen.
We'll return to that news a little bit later this morning. Just to focus on the payrolls number, fantastic lineup later this morning, 8:45 Eastern time. We'll get the latest from Bill Dudley, the Bloomberg opinion columnist and former New York Fed president, to respond to the economic data, and TK, a column a little bit earlier this week on bank regulation. We'll make some time for that a little bit later too.
Every word was of value. It was a blistering essay from the former head of the New York Fed. And John, I'm sorry, it's a really important column about whether there's still risks of the broader American banking system.
That analysis about 2 hours away. The jobs report just around the corner. The median estimate in our survey, 175,000. The price action has been weak to start the new year. 4-day losing streak on the S&P this morning. We're down 0.3.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Trend signals have finally turned long, and I think this is an epic signal for the market because we have been short for 9 quarters. This has been one of the longest shorts in trend following history over the last 20 to 40 years. And I think this is important because it signals the end of the tightening cycle, and it suggests that we're going through a regime change and that we need to start looking at the next phase of the bond market.
Katie Kaminsky of Alpha Simplex, the final 2 months of that last quarter, super painful, big move lower in 10-year yields. Your 10-year yield this morning shaping up as follows. Your 10-year yield a little bit higher and back through 4%, 4.0381% on the week. Yields higher by about 16 basis points. Worth framing it over the last couple of months, though. The 10-year yield was lower by more than 60 basis points in November, down close to 45 in December. And Tom, just encouraged by some better than expected data to start the new year, yields pushing in the other direction.
Well, yeah, and over 4%, and I guess, we're hugely data dependent. And again, how important is JP Morgan earnings? I mean, over the holiday, 1 week away, and they were saying they're capturing 1 out of 5 profit dollars in American banking. Maybe that's as big as the jobs report.
At the moment, I think the big number, TK, is the one from Apple. Early February, start the year, 2 downgrades,
sales hysteria,
big
China,
run up through 2023, a lot of more multiple expansion. Sales of the iPhone, not great. We'll see what the quarter looks like.
And to their credit, they write a blisteringly clear report when it comes out. I mean, their PR staff, their IR staff.
They get an A from you.
They get an A from me for clarity. Like, you can actually read the thing. One of the things you can read is Anna Wong's economic literature, chief U.S. economist at Bloomberg Economics. Every report is at least 42 pages long, except when she stops traffic in tweets. Anna Wong joins now from Bloomberg Economics. You stopped me yesterday, Dr. Wong, with a spectacular tweet with the Anna Wong famous red pencil on the birth-death study of the Bureau of Labor Statistics. We now go wonky on Jobs Day. Anna Wong, do we actually know what our job numbers are, or are they adjudged, are they changed by the births and the deaths in America?
Yeah, so, the BLS adjusts their each month survey number with a model estimated result from a model called birth-death model that aims to capture the job growth of small firms. And those estimations are based on benchmark results from a year ago. So what oftentimes happens is when you have turning points in the economy, you have a lot of volatilities with new firms and bankruptcies. As we did see in 2023, we had elevated bankruptcy rates. And that's when the birth and death model tends to overestimate the amount of job growth. And in 2023, 42% of the non-farm payroll gains is due to the estimated increase of jobs in the birth and death model. So I think it's open to, indeed, people's skepticism on whether they're right. Yeah.
We're getting tons of emails on this, that the job numbers are not nearly as rosy as people like you are telling us. Now, you're at 140,000, so you're already beneath the survey for today. Are we going to sit here in March or July or November next year and say, oops, everybody got the small business birth-death model wrong, and the American labor economy is a lot weaker than we knew?
Well, I think the most important is what the Fed thinks. And I think the Fed is aware of the flaws with the birth and death model. And they actually do think that the real situation is weaker than what the job number thinks. So my tweet yesterday is actually coming from the Fed's Green Book back in 2001. So yes, the Fed is totally aware that the situation is not as rosy. And so this is why in turning points of the economy, the Fed tends to focus more on anecdotes and what their business contacts told them. And I think one of the key reasons for last December's Powell dovish pivot was because they put a lot more weight on what the district contacts have been telling them, and that was reflected in the Beige Book, which was the most downbeat Beige Book since 2020 in November 2023.
Anecdotally, Anna, though, we've seen a lot of pessimism. The sentiment has been really, really underwater for a while, and yet the economy has overperformed again and again, surprised everybody, a lot of people who were expecting recession last year, including yourself. Why have the numbers not cohered at all with that? Why do we think that they're going to show something different this time around?
Yeah, I think it's not clear at all that the economy did not slip into a recession in the last 3 months of last year yet. I think in terms of if the narrative is that GDP number is very strong, well, it turns out that in the quarter before 2007 December NBER, recession declaration, GDP was also running at 4.9%. And in fact, the NBER, the Business Dating Committee themselves, recognize that GDP is actually not a very good real-time measure on what's really going on with the economy. On the other hand, if you look at CapEx intentions and also what the Fed regional surveys is describing the economic conditions to be, it was actually quite weak. So for what matters to how the Fed get their information, how much weight they place on the incoming data, I would say at this point, when you have a turning point, you put a lot more weight on what your business contacts are telling you. And I think right now, I still see that the reason for why we think possibly some recessionary dynamics had begun in actually October of 2023, I think all the reasons are still there.
If that's the case, if we already have seen the start of a recession, does that mean that we're almost out of it, that we're almost to the recovery because basically people are already kind of reshaping around a new post-pandemic economic reality?
Yeah, that's a very fair point. So our view is that one of the key reason for a soft landing or a very, very mild recession is if the Fed comes to the rescue early, if the Fed cuts rate early and fast. And, our using some state-of-the-art model, we found that Powell's pivot in December is equivalent to 13 percentage point rate cuts. So there you have it. You don't need to wait for the rate cut in whether it be March or May, but de facto, the pivot by Powell in December already is equivalent to half of a rate cut. And that could certainly make this recession extremely mild and very short.
The market's been cutting rates for them. Anna, thank you. Appreciate the update. Anna Wong there of Bloomberg Economics. And a happy new year to you as well, Anna. That jobs data, just around the corner, the estimate 175,000. TK, I think it's hard to get your head around this. When you hear people talk about recessionary dynamics beginning and jobless claims that are around 200,000, unemployment south of 4%, at least it is at the moment. We'll get an update on that a little bit later this morning. And we're talking about jobs growth of 175.
It's bizarre. If you parachuted in from 20 years ago, you'd say, you got to be kidding me. It's completely pandemic-induced, stimulus-induced. But the thing I would go to, John, and it shows the confusion of the birth-death study that Anna Wong is brilliant on. Truly extraordinary work by Dr. Wong. And that is the technology overlay right now. Anybody who tells me they have any certitude on what the technology impact is on America right now, I'm just going to ignore them. Nobody has a clue.
The optimist would say that real wage growth is improving. Lisa, you remember the outlook from Goldman, Jan Hatzius and the team? Lisa, they were talking about the tailwinds for 2024 and the hard part being over.
The optimist would say that we had a rolling recession. It rolled through a lot of different places. The averages didn't show it, and now we've got the recovery on the way. And this sort of is, where are we in the cycle? Are we at the end of the last one? Or are we already at the beginning of the new one with people projecting out a lot of strength this year? I mean, this is some of the discussion point. And then you throw in a number. What do the numbers mean anymore if you're trying to cobble together all of these different rolling economic cycles of specific industries?
Between goods and services, et cetera, all questions we'll ask at 8:30 Eastern time when this number drops. The number we're looking for, 175,000. Priya Misra of JP Morgan Asset Management will give us a preview in about 5 minutes' time. This is how the market's set up for you. You're all familiar with the moves over the last few days. 4-day losing streak on the S&P. On the NASDAQ, a 5-day losing streak. On the NASDAQ, incidentally, the longest daily losing streak through the whole of the last year, all the way back, Tom, to late 2022. We have not had a 5-day losing streak on the NASDAQ 100 for that long.
I saw one survey that had a series that was back to, I believe it was 1978. I mean, there's some real carnage here as well. We're going to keep the coverage going here, John. You got to do this because in the next 5 minutes, I got to try to figure out what the FA Cup is in London. Tots are playing Burnley. I have no idea.
How many times have we explained this? How many times have we explained it?
Why do they have so many leagues?
This is how he's prepping for Jobs Day.
It's not a league.
Burnley?
It's not a league. It's a cup.
It's a
cup. You know this.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on context changes everything.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Take to be a great surgeon. This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
The thing that gives me the most anxiety is perhaps a cut that comes too soon from central banks.
Markets are expecting that they could move as soon as the next couple of months. We think that that will be too soon.
We should be thinking about whether or not they'll have to restart the rate hike cycle.
I don't think we're at an inflection point at the moment.
Trend signals have finally turned long. It signals the end of the tightening cycle, and it suggests that we're going through a regime change.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
TK, big question. What's your hangover cure? What's your go-to?
A morning martini. No.
Inquiring minds want to know.
No, I don't. You know, I don't really have one because I'm very careful.
Tang. Okay.
I'm
Tang.
careful.
Tang.
But
I asked this because the
Tang is the start.
The New Year hangover continues in the market.
It does.
Do you like
it
that?
Does.
From New York City this morning.
It's nice to
Good morning. Good morning. I was expecting better than that. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P negative by 0.25%. You know the numbers now. 4-day losing streak on the S&P, 5 days on the Nasdaq 100. The losses, TK, just building to start the new year.
Well, they are in the equity markets. You're seeing it, and it's where we're saying earlier, 2-3 days down, you hit support. Well, guess what? On many cases, it's not just Apple. We're going through support, or if the series is going the other way, through resistance. Something as nuanced, John, as Swiss franc. I have continued through the week persistent bid on Swiss franc, just as one global example of how the first couple days have been ugly.
There's a new number to look at as well. It's got a 4 in front of it. on the 10-year, 4.036%. Yields up this morning by 4 basis points. Lisa, it's about payrolls today, 175 the estimate. But yesterday the data was decent, pushed yields higher.
It's about crowded trades and people unwinding some of those. And one of the crowded trades was that the Federal Reserve was going to cut rates pretty aggressively this year in response to weak economic data. The data has not been particularly weak, and so people have to retrace that. How far do they have to retrace that if we get a better than expected number today?
That's the data. We need to talk about some risk in the Middle East as well. An update from the container shipping giant AP Moller-Maersk, Tom, saying it's decided that all vessels due to transit through the Red Sea will be diverted around the Cape of Good Hope for the foreseeable future. That update, Tom, in the last hour.
Yeah, the foreseeable part is there. It's very tangible, and, you know, we walked through it. It's a 2,500-mile extension on the trip China to New York, but you know, I wonder what it actually means versus the absolute miracle that is the Suez Canal, and has been a miracle for decades and decades and decades.
Mike Shepard of Bloomberg joining us in about 10 minutes from Washington, D.C. Look out for that conversation. Here are the scores to start your morning. Here's the price action on the S&P 500, negative 0.2%. Talked about yields going higher by 4 basis points, back through 4% in the FX market. Off the back of that, push it through foreign exchange, leads to dollar strength against the euro, 109.16.
Basically everything on its head from the end of last year. What we're watching for today, obviously the big deal, 8:30 a.m., as Tom says, the Super Bowl non-farm payrolls report for December, the last one for 2023 at a time where a lot of the labor market data has been coming in stronger than expected. 175,000 is the estimate. What I'm watching is average hourly earnings. If they increase by 3.9% as expected, is this good enough for a Federal Reserve cutting rates as soon as March? 10 a.m. we get ISM services data. The services sector continues to be strong. It's been in expansion territory for about a year. It's been actually in expansion territory if you take out 1 month since May of 2020. Can that continue? And at 1:30 p.m. we hear from Richmond Fed President Tom Barkin, who's spoken a couple of times this week. We also, I'm glad to say, have a number of former Fed officials who are going to be joining us today, including Randy Krasner and Bill Dudley, to give us their perhaps unfiltered thoughts.
It's always nice to get the former officials. Bramo, I'm with you. TK, they always seem to say what they really think.
Oh, yeah.
Less guarded than the current Fed officials.
And you see their academic distinctions as well, and that includes Dr. Dudley and all the work he did at Berkeley years ago.
Bill Dudley, 8:45 Eastern Time. With us right now around the table here in New York, I'm pleased to say, Priya Misra, Portfolio Manager at JP Morgan Asset Management. Priya, good morning and Happy New Year.
Happy New Year to you too. Thanks for having me.
Fantastic to see you on this Payrolls Friday again. Let's start with payrolls. What are you and the team looking for? How do you expect this bond market to respond to it?
So, we're looking for sort of this 170, 180 number. I think, the market's probably a little bit overdone or was overdone into the end of the year. What we're seeing is sort of this pullback. I actually think the risks are somewhat asymmetric. If we get another strong number, if we get a high average hourly earnings number, this narrative that this immaculate disinflation has, will essentially allow the Fed to cut rates as early as March, I think that gets pared back. So interest rates can rise. I think we get a bigger reaction to a very strong number. But I will say, we're in a very interesting time. We're in this inflection point. The Fed has clearly done in terms of rating, in terms of how much they're going to raise rates. When do they start to cut? How much do they cut? Are they normalizing? Are they easing? We're in this very tenuous period, which is why the market's going to be volatile. I think this year is about significant uncertainty. Today's number might just suggest that the economy is continuing to normalize, but not weak enough for the Fed to start to cut early. So I think we're going to remain extremely whippy. It's about positioning. It's about the fact that in the last 2 months, we went from 5% on the 10-year to 380. So I think we're sort of consolidating here. I actually think anything above 4% is an attractive level to own if you own risk assets. That correlation is going to come back because it's all about how quickly can the Fed try and get that soft landing.
How big is the spread between what you think the Fed will do and what you think they should do? I ask because, as you know, your colleague is in the FT this morning, Bob Michaels, saying the Fed should cut probably now to get ahead of the next shock. Is there a big spread between what you think they will do and what they should do?
I think there is a big spread because it's all about how restrictive is policy right now. I think, in our view, long and real rates are clearly in restrictive territory. Are we seeing that in the data just yet? No. I would say we're seeing cracks in the data. We're nervous that these cracks are going to deepen, which is why the Fed should actually remove that restriction, start to at least to get to neutral. But the Fed, I think, wants to really put that inflation genie back in the bottle. And inflation has been surprising to the downside. We're in this immaculate disinflation, but it's not going to be a straight line down. You see European inflation starting to come a little higher. And I think that's going to make the Fed a little nervous. So I think there is that big gap. The longer that gap increases between when the Fed should start to cut, how quickly they cut, I think the odds of a hard landing start to increase.
We don't do Cartesian geometry on Jobs Day, but the answers to your point is the real yield is hugely extended. I looked at the 2-year real yield and was stunned at something fancy folks call the integrand. And the answer is, what's the urgency for the Fed to get the 10-year real yield down and give us a level where we begin to see that? At a 170, do we need to get to 150 fast to provide some comfort, some ease?
I think it would help. I would say closer to 1% on 10-year real. I would say that's the level you sort of need.
She's just great entertainment. Are you kidding me? A 1.00?
Well, I think that's the level, that's the neutral level. If the Fed really wants to ease, they have to go below that. Are we going to get there anytime soon? Not with QT, not with the fact that inflation's not heading all the way down to 2%. And I think you really need either QT to stop or at least start to pare back. They've started to talk about it, but they're not close to getting that done. Or the Fed actually starting to talk about cutting rates. I think the struggle the Fed has is the moment they start, the market's going to price in all the way down to 2%, 2.5%. And the Fed really wants to nuance that message and say, no, we're only cutting to normalize, to reduce restrictiveness. The messaging problem, I think, is going to make the Fed slow in terms of trying to bring those to, long and real rates lower. But yeah, I think you need close to that 1%. Look at housing affordability, or look at when,
Lisa, if she gets this wrong, she's going in the basement over at the new building on Park Avenue. That's a bold call from Priya Misra.
Just to sort of give it some perspective, the 2-year real yield is currently close to 2.4%. So that's a pretty big decline. If this were to transpire, this is all coming at a time where you're saying they want to see that disinflation. They want to put the inflation genie back in the bottle. And you pointed to Europe. And I think that it's important to take a look at why inflation reignited. It's because oil costs surged. Some of the subsidies rolled off. Some of the subsidies just in general, and some of the government-fueled injections also rolling off. How much is that going to be a problem for the Fed if, let's say, supply chain disruption spurs inflation, if the Middle East and an oil shock spurs inflation? Is that going to be enough to keep them from cutting rates, even if that's not good for the economy?
Right. I think they're going to look at the labor market, which is where today's average hourly earnings number is going to be important. If that number is sticky on the way down, I actually think then these supply chain issues, even though it's not good for the consumer, I think it's going to, if it keeps inflation elevated, they really want to get inflation trending close to that 2% and can slow them down. Now, I think the Fed will say when we start to cut, we can cut a lot faster. So they can always, go faster once they start. But I think if you have geopolitical risk, I think it's something we're dealing with multiple wars, this what's happening in the Red Sea, that can just make the Fed a little reluctant to start to cut unless the labor market starts to slow down. And it's not slowing down fast enough, I think, for the Fed to be concerned about wages.
So what's the threshold, if you put some numbers on it, given the fact that people are expecting 175,000 for the non-farm payrolls number that we get in about an hour and 20 minutes? How low would it have to be to trigger real concern from the Fed, regardless of inflation?
I think around 100,000 would be that level, because that's the level at which point the unemployment rate starts to rise. And the Fed knows that inflation is a lagging indicator. If you get close to 100, that implies that wages are going to start to come down. And I think that's when the Fed says, okay, this is not normalizing. This is, maybe the lags are finally taking effect. So I think that's the level in terms of payrolls. And I think for wages, you need something in that 3.5% average hourly earnings over a 3 to 6 month annualized pace. I think that's the level where they'll say, okay, maybe we have more faith that the inflation genie is sort of heading back into the bottle.
What are the chances of a pickup in growth again, a re-acceleration, after the massive easing of financial conditions we've had in the last couple of months?
I think that has to be a concern for the Fed, but I would still go back to real rates, to Tom's point. If real rates in the long end are that high, I don't know if it re-accelerates growth. It can slow down how quickly things are slowing. The fact that financial conditions have eased can offset these high real rates. I do struggle with the re-acceleration narrative. I think we're debating how quickly are things slowing down. Are they slowing down enough to that threshold question that the Fed can afford to? They're really trying to get that soft landing. I think they can see that path and they're trying to get there. Will the market and inflation allow them to do that?
It's off your remit, but I'm going there. With your bold call of dramatically lower real rates, what's it do inside 2 years? What's it do to the LIBOR, the SOFR market? I mean, basically, it's a refinancialization of finance, isn't it, with a gift of low real rates?
Well, I think the low real rates I'm talking about is more further out. Once
Yeah,
the
I mean,
Fed
that's your
starts
job.
to
I get that. But, no one's listening. It's just jobs day. Stay with me here, Priya. Come on. Inside, if we get a Priya-Misra world, we refinancialize our finance system. It's a gift.
we get SOFR rates then close to, in a soft landing, close to 250, 275, in a hard landing. And do we get that? I think the markets run away with this thesis that here, soft landing, here we come. But if the lags are kicking in, if those real rates are going to force things to slow down, as everyone who's been locked into these low real rates starts to refinance and realizes those real rates are high, those SOFR rates then are going below 2%. That's not priced in at all.
My takeaway this morning from you think this 4% yield right now and this 10-year is a buy.
I think it's a buy. I think we scale back a little bit below 4% because the data is not weak enough. But I think you get 4, anything north of 4. We're not going above 420, I would argue, because that's the level where the Fed said we're done. Essentially, that's what they told us in December, and the bar to cut is not that high. So I think that's the level, anywhere between 4 and 4.2, I would say is a buy.
Interesting. Priya, great to see you. Happy New Year. Looking ahead to the year ahead. Priya Misra there of JP Morgan Asset Management. If you are just joining us on this Payrolls Friday, you hear the scores on the S&P 500. Equity futures negative here by 0.25%. Yields are a little bit higher by 3 basis points, 4.0325%. We need to be talking about what's happening in the Middle East. And what isn't happening, Lisa, the latest from shipping giant AP Moller-Maersk.
For the foreseeable future, they are going to reroute away from the Red Sea, and we're seeing already since December, when some of these reroutings began, a huge surge in the cost of shipping, a huge surge in the cost of insuring some of these container ships. So here's the question. Does this materially cause any kind of inflation? Does this materially cause some kind of supply shock that suddenly reignites some memories of the pandemic? How much does this have a real effect on the economy at a time when we're focused on jobs, we're focused on metrics that already have been muddied by the pandemic?
Bloomberg's Mike Shepard just moments away down in Washington, D.C. to get you up to speed on that story. In just about an hour from now, Nadia Lovell of UBS, 8 a.m. Eastern Time, looking ahead to the jobs report and the year ahead for equities. The UBS view is just around a corner. The payrolls report just around a corner as well. 175, the estimate in our survey from New York City this morning. Good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand.
Connection lost.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
I personally think President Trump was the right president at the right time. I agree with a lot of his policies. But the reality is, rightly or wrongly, chaos follows him. And we can't have a country in disarray and a world on fire and go through 4 more years of chaos.
If you've run before, promised things, didn't deliver, and then you're running on the same things, wouldn't it be reasonable to say, well, gee, I don't know that I can take that to the bank going forward? So, yes, I think the fact that he's campaigning on something, that does not mean that he would actually follow through on it.
That was presidential candidate Nikki Haley. Governor Ron DeSantis speaking yesterday in back-to-back town halls on CNN. Both candidates taking aim at the former president. From New York City with payrolls about an hour and 15 minutes away. Here's the state of play. Equity futures negative again. We're down 0.25% on a 4-day losing streak through Thursday on the S&P 500 and on a 9-week winning streak on the S&P. And Lisa, well on course to snapping that a little bit later on this afternoon.
So here's the question, right? Do we end up seeing a trend that really can follow through the rest of the year, or is this just people resetting after a blockbuster last couple of months to the year? And honestly, I don't have a clear answer. We have the likes of Phil Camparelli, who came on and said, he's still bullish. This is just normal volatility, which basically means a little selling and then you buy.
The boat is so loaded to the one side coming into 2024, looking for rate cuts, that a little bit of better data, Tom, just pushes things the other way. And we've seen that in the last 24 hours. Yields up again, up 3 basis points today, on a 10-year, back through 4%.
Well, and the tape is showing it. I mean, the equity tape is a little bit soggy here as well. Maybe we're waiting for 8:30 this morning, but the fact is it's day after day, and when do you get a turn? I thought we had a turn yesterday. Didn't work out. I mean, just plain and simple.
It didn't work out at all. Just the weakness continues. Phenomenal to see the NASDAQ on this 5-day run. 5-day losing streak, and it's the longest since 22, which I think speaks more to the strength of last year than it does the weakness of 2024, Tom. Just last year was absolutely phenomenal.
I mean, it's interesting, and after that incredible interview with Priya Misra of J.P. Morgan, the 10-year real yield market down 1.7955, rounded up to 1.80. Misra looking for substantially lower inflation-adjusted yields. Today's an August day. It happens every 4 years where I actually read a memo on the Iowa caucuses. I like what PBS says. PBS says, are both the Republicans and Democrats holding caucuses in Iowa this year? And the PBS answer is sort of. Providing us with wisdom this morning on the political season, Michael Shepard, driving all of our U.S. government coverage for Bloomberg News. Michael, I love the sort of it. Give us some clarity. I'm biased to the New Hampshire primary. Give us the so what on the Iowa caucuses.
Iowa matters even more this year, Tom, and thank you for having me, than before, because this is where Donald Trump, who has been running his campaign as an incumbent among the Republican field, is looking to score a decisive victory to put Nikki Haley and Ron DeSantis far in the rearview mirror. And he will need that from a state that he has ties to from his prior administration. When he was in office, his ambassador to China, one of his top targets during his years in office, was a former governor of Iowa. And he had other people, including an acting attorney general, who are now active in helping him in his comeback bid.
How is it that we have a nation's incumbency in the Republican Party decided by 12 people sitting around a fireplace in somebody's living room? I mean, it's January. Is he really going to wrap it up that early, even to say he's going to wrap it up in New Hampshire?
Well, the way that Trump has worked with the Republican Party to set up the rules, Tom, over the past year for all the primaries through the course of 2024 has worked to his advantage. So if he scores a big win here, it builds up momentum. And even if Nikki Haley keeps it close in New Hampshire, by the time we get to a lot of the other states, it will be much harder for her or Ron DeSantis to make up that lost ground and pick up the delegates that they would need to secure the nomination. And to be fair, in Iowa, it is more than just a handful of people huddled around a fireplace. There are bigger meetings there, and a number of people in the state will turn out. They're very actively engaged in the state's politics. We've had reporters out there over the course of the past several months, including in December, and we'll all be out there in force with our Bloomberg teams again to find out what's on voters' minds. And two things that we're hearing. One, of course, is the economy, but the other is also immigration and border security. And those are things that Donald Trump is using to his advantage in this campaign.
We'll get to immigration in a second, but with the economy, we are going to get a jobs report today. We've been talking about why people have been so pessimistic, given that the economy has actually been performing pretty well. I mean, the expansion in December was pretty significant. What's the explanation for both the Republican side and the Democratic side for the disparity between the official numbers and how people are feeling?
That's a great question, Lisa. I'm glad you asked it because we have been looking at this ourselves. In our Bloomberg Morning Consult poll of the 7 swing states that we think are going to be decisive in figuring out the election outcome in November, what we are finding is that people do not trust President Joe Biden on the economy. They're disappointed, and they are concerned about where the national economy is going. They are feeling unease, and they say they trust Donald Trump more by a nearly percentage point margin to handle the economy. And you can look at it this way. When you go to the grocery store, while we see our reports that inflation is easing, those prices for goods like milk and eggs and cheese still remain high from what people remember, say, 3 or 4 years ago.
There was a story in the New York Times that really caught my attention because people say this is unprecedented to see this sort of disparity between how people feel and the overall economy. They pointed to Harry Truman in 1948 in the election when he was looking at a north of 7% inflation rate, but also sub 4% unemployment rate, and talked also about how frustrated people felt and how they actually would have been willing to take a pay cut rather than see some of their prices continue to rise in the grocery stores. How similar is now to then versus the 1970s and a very different kind of time?
Well, you know, it's such a different economy that it's really hard to make a clean comparison. But there are elements that really carry over. And certainly for the Biden team, it is a huge source of frustration. They have been trying to pitch their successes in getting the president's domestic agenda passed within his first 2 years in office. That included a big infrastructure package, the Inflation Reduction Act, which brought all these big subsidies and initiatives to promote construction of new electric cars. And they are not seeing any reward from that. The whole Bidenomics pitch has fallen flat with voters.
They're herding cats at the moment, Mike. Let's finish on this. Foreign policy and international security. We've got these issues in the Red Sea. We've been talking about the latest from AP Immerse this morning. It doesn't feel like it even features, Mike. It just keeps coming back to domestic security, the southern border. Is that the story at the moment in this campaign?
The southern border really is emerging as a major issue. And we saw earlier this week House Speaker Mike Johnson heading to Texas along with 60 of his Republican colleagues to visit the border and see what's going on there and then use that as ammunition in their argument to President Joe Biden and to Democrats in Congress for tougher border measures. And they have been using that to hold up aid to Ukraine for months. President Joe Biden asked for a $60 billion assistance package for Kyiv. That was back in October, and we still have not seen action by Congress to pass that and get that through. That's been frustrating to the president, but even more so worrisome for Ukraine. The president of Ukraine was here in December trying to make his case and to no avail. And this is raising concerns that America might be losing its will in something that President Joe Biden had called very important, and that is making sure Russia was held to account for its invasion of Ukraine and to help Ukraine as much as possible in expelling that invasion.
The fighting continues. Mike, appreciate the update. Michael Shepard there of Bloomberg down in Washington, D.C. Thank you, Mike. It's EK. There are many issues. It's like herding cats right now for this administration, but the southern border quickly becoming one of the big issues for 2024.
I can't remember the date, the December 27th, December 24th. I really can't remember, but I'm with Greg Valliere at AGF on this. There is no other issue, and you hear it from Republicans and particularly, and of course, folks in Manhattan, we hear this from Mayor Adams, but you hear this from Democrat, city, mayors. There's a different tone in their voice.
Lisa asking the right question on this Payrolls Friday. We're talking about a number of 175K, and you ask people how they feel about this economy, how they feel about this labour market. It doesn't speak to those headline numbers we're looking for in about an hour and 5 minutes. Coming up next, Sarah Wolf of Morgan Stanley with an hour to go until the payrolls report. In our survey, the number we're looking for, the median estimate, 175K. Sarah's joining us next. Your equity market's lower. We're negative 0.2%.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Coming into the new year, coming into this week, we were on a 9-week winning streak on the S&P 500, the longest weekly winning streak going back to 2004. We're about to snap it based on a price action of the previous 4 days on the S&P 500, negative, 4-day losing streak, down 5 on the Nasdaq 100. We're negative 0.2% this morning on the S&P. On the Nasdaq, we're down by 0.3. The Russell, the small cap, suffering, Lisa. We're down about 0.8%.
It's a reversal of what we saw at the end of last year, but there's this real tension right now. Can you see a rotation with some of the pressure that we've seen so far? People were saying, yeah, you could see a sell-off in big tech, but you could still see that rotation, that broadening out. I don't think so. That's sort of what we've seen.
Well, we're seeing a rotation out, but I'm sorry, the jobs report and the revisions today, I think will fold right into the market. And people are, the bulls are desperate for some optimism here. Maybe they get it. You get the 140 and a Wong number, you get 110 with revisions, rounded out to 150, say, and that's the tendency in the right direction to keep the song and dance going.
So far, not great. We're turning the end of 2023 upside down in equities and bonds as well. Big rally in the bond market, November, December, unwinding some of that to kick off January 2024. Yields are up again by 3 or 4 basis points. The 10-year through 4%, 4.03% on a 2-year, up a couple of basis points. Lisa, let's call it 441 this morning on a 2-year.
What I think is interesting, I keep thinking about this, Priya Misra is saying that it's basically a buying opportunity anytime that the 10-year yield is between 4 and 4.2%. And a lot of this coming with this idea that it will be a 60-40 kind of ballast, once again, the kind of idea that Phil Camporelli was talking about. It's just an interesting moment that seems to be a real shift at a time when we're sort of recalibrating after a strong last year.
The data so far has been better than expected. Upside surprise on ADP. The right kind of downside surprise on jobless claims. Whatever that's worth, December data, I get it, but it's pushing the market in the other direction. So take the bond market, push it through foreign exchange, yields up, dollar stronger against the euro. We're negative 0.3%, 109.16. That's the price action. Here are your top stories. Under surveillance this morning, an hour away from the jobs data in the US. Wall Street's big banks out with their estimates. JP Morgan coming in at the low end, forecasting a gain of 150,000 jobs. Goldman and Citi at the top, looking for a print of 190K. Sarah Wolf and the team at Morgan Stanley expecting a figure close to 180,000. Sarah's going to join us in just a moment on that. But TK, you can see the big banks on Wall Street grouping somewhere around 150 to 190.
150, the whispered number, maybe is higher, but I'm going to go again. The revisions are absolutely vital here. And then I'm going to take a 3-month moving average in to see if we have a tendency towards a lower non-farm payrolls, because we're not getting that tendency in claims as a secondary statistic.
That data, 58 minutes away. The latest news, developing story in the last couple of weeks, more news, more headlines in the last hour on this, Lisa. Maersk saying it's decided that all vessels due to transit the Red Sea will be diverted south around the Cape of Good Hope for the foreseeable future. Maersk saying it's encouraging customers, quote, to prepare for complications in the area to persist and for there to be significant disruption to the global network.
And this already we've seen being priced through some of the shipping rates, which have increased significantly since December. At what point is this an idiosyncratic story for the shipping companies? And at what point is this a broader economic issue for costs going up with supply chains being somewhat disrupted?
I have my stereotypes of this, and I am wrong. It's at the 35th latitude south, where the Cape Horn in South America is way, way down. Way more treacherous, the Straits of Magellan, going around the Cape of Good Hope in modern-day sailing. And John, it's not as treacherous as what we learned in school about shipwrecks years ago.
Southwest South Africa. It's a much longer journey. Much longer journey.
It's a 2,500 miles, Shanghai to New York City, you add to the journey.
Nuts.
Yeah.
Crazy. Let's finish on this story. Demand for popular weight loss drugs like Ozempic and Wegovy threatening to drain state and local government healthcare budgets. Medicaid reimbursement for the GLP-1 drugs has more than doubled over the last 2 years to $8 billion from $3 billion. List price for the drugs can rise above $1,000 a month. Drug makers Novo Nordisk, Eli Lilly, claiming this, Lisa: the drugs will pay for themselves, with obesity costing the US healthcare system $173 billion every single year.
I am so glad that we're talking about this story. There have been a whole host of different Wegovy and Ozempic stories. This is a real question. Who bears the cost? When is this going to be covered by insurance? How do you calculate who actually benefits on the other side? Who's going to pay for dialysis? Who's already paying for all of these other things that are associated with obesity and diabetes? So these are some of the questions as we try to parse out, is this the same kind of macro trend as artificial intelligence, right? Are we all just living in an Ozempic world where suddenly obesity is not going to be an issue? People are going to have to eat less. You're going to have a different kind of consumer experience at the likes of McDonald's.
I'm walking down Lexington Avenue and there's a little sign out like they're selling M&Ms or pizza or something. It says, come on in and get your Ozempic.
It does not say that.
No, it did.
Does it really?
Yes,
I've
there
not seen
are.
that.
Yeah, there's little signs.
Yeah, like the ones
come
like
on
the
down and get your...
outside of delis. He's making it sound like you just walk past your local
It's a
bodega.
storefront.
No, John, that's what it
Come on
looks
down.
like. I don't...
You go past like a pharmacy or a
Did
doctor's
the three
office.
of us decide that this is a free lunch? That
Really? Like
Yeah.
delis and...
Not quite delis, but they're just sort of storefronts that have sort of unclear
Come on in,
kinds
get your
of
Ozempic.
signs that are just saying, like, come in.
Have they replaced the old COVID testing places?
Yeah.
Old COVID and CBD distribution.
It's good.
Yeah, I mean,
Because many of those stores have been empty for a long time. So it's
Sarah Wolf's
Good
going to
for the
stay.
economy.
Yeah, exactly.
Let's bring it back to the economy.
Well, they did say it'll pay for themselves.
Exactly, so
this
that's
is-
maybe it.
It's all feeding
You
the
guys
US
have been
economy.
talking about Ozempic. I'm sitting over here with Sarah Wolf of Morgan Stanley. We've been deciding when you take your Christmas tree down. It's a huge debate here. I'm way behind. Pharaoh had the beast out on the street, December 27th or so?
No, I hate the tree. The tree graveyard I find really depressing.
It's
in
very
Manhattan.
depressing.
I find it
It's
very
huge.
upsetting. I really do.
Right.
But you know me, I've got a fake tree.
So-
And it came down on January 1st,
Okay.
before the sun came up.
Let's take a poll here. Help me out on Twitter and LinkedIn to see if I should take the tree down this weekend. I'm holding out for February. February, we'll have a better look at the jobs market. Sarah Wolf joins right now with Ellen Zentner, senior economist at Morgan Stanley. Let's just cut to the chase. What's your call today? Are you coming in below consensus, above consensus? What's your level of enthusiasm for the labor economy?
We're more or less in line with consensus, 180,000. I think consensus is shaping up around 175. More or less jobs are going to look quite a bit like they've been looking the last couple of months. We don't see that there's real material downside. One thing to take into consideration, construction, typically a big downside in December because of weather. We've had a very warm, enjoyable December, so that could add some upside. We also got quite a bit of softening in retail trade in November, so we shouldn't see quite as much weakness going into December.
Anna Wong, Dr. Wong over at Bloomberg is looking at the birth-death dynamics here of small business, mid-sized business as well. Is the unemployment report hiding or masking greater challenges in the American economy? Is the number actually going to be revised lower 6 months, a year from now?
It's definitely possible. As you're going into a slowdown in activity, the birth-death model, it's a bit of a laggard indicator, so it's not really capturing in real time the death of businesses. I think we're probably getting a little bit more of that softness showing up in the ADP data, which has been pretty consistently running slightly below the non-farm payrolls data, and that does a better job of capturing small-sized businesses where more of the deaths have been concentrated.
Headline, ADP matters. Headline, ADP may matter more than non-farm payrolls. Is that what you're saying?
ADP doesn't necessarily matter more than non-farm payrolls, but if we're trying to think about where the weakness is in hiring, we know that more of it has been among small businesses, and ADP samples more of the small businesses in real time than non-farm payrolls, and so we could get some of that revision downside later on in the non-farm payrolls report.
Given the fact that you do have all these varying measurements and such disparate kinds of economies that are moving at different paces, how valid is it to even look at the payrolls number to get a gauge of where the economy is? I mean, when you talk about Anna Wong, she was saying maybe we already had a recession, that we're actually in the recovery already. Do you buy into that kind of idea?
We've definitely been in somewhat of a rolling recession, but we could all agree we have not been in a labor market recession. So maybe the housing market was in a bit of a recession, durable goods expenditures have been in a bit of a recession, equipment investment. But if you look at the labor market, I don't think we're going to look back and say, oh, the labor market was in a recession in 2023. The labor market is still very strong. As you guys have all mentioned, jobless claims very low. The JOLTS data that we got earlier this week is showing openings are coming down, quits rates coming down, but layoffs have barely inched up. So yes, somewhat of a rolling recession, but the labor market, which is really the key for are we in an overall economic recession, is still holding the front.
So do you think that we could end up avoiding one entirely, that essentially this is what you get, and that especially because companies have been conditioned by the pandemic, want to hoard labor, we're seeing that because people are getting jobs in industries that were so understaffed heading into the pandemic. Do you think that we could just sort of stay here and not rise above 4.1% unemployment?
Definitely. I think there's two things happening in the labor market. You still have a group of industries that have backfilling that still needs to happen. So if you think about healthcare and education, they still have quite a bit of hiring they need to do, and so that's going to add a bit of a cushion. If you look at healthcare alone, it's been adding 70 to 80,000 jobs a month to non-farm payrolls. Government as well still has quite a bit of hiring. It's been adding 30 to 40,000 payrolls. So you still have these catch-up industries that are going to give a nice cushion to payrolls in 2024. And then, as you mentioned, you have labor hoarding. So we dealt with a lot of scarring from not having enough workers for 3 years. And so even industries, think about retail trade, wholesale trade, construction, that maybe have right-sized their workforce, are very hesitant to let go of their workers. And from my seat, I talk to a lot of consumer corporate companies, and all across, whether they're food services, retailers, they're still saying that they're very focused on worker retention and not looking towards layoffs next year.
Wage growth today, there's month over month, year over year. Someone previous said 3-month annualized matters. What is your metric of the inflation component, the vector, if you will, of wage growth?
Of course, the preferred metric is the employment cost index. It's a bit more steady,
Agreed.
but we get it at a
4%.
lagged indicator. We get it lagged, and we know that it's been coming off its peak for about a year. Still quite elevated, I'd say. Still a little uncomfortably high.
So is there value today in AHE given the importance of ECI?
Now that we're not seeing as many dislocations in average hourly earnings, because we were getting a lot of volatility in average hourly earnings due to where we were seeing layoffs and where we were seeing hiring back, I do think that average hourly earnings is still worth looking at as a pass-through into the employment cost index. We're looking for 0.3% on the month, so that's a bit of a step down from last month, 0.4. The important thing is that that year-over-year pace is continuing to notch its way down each month.
Your conclusion this week, read your research, no cuts soon. No rate cuts soon.
No cuts soon. When we look at the minutes on Wednesday, I mean, there was nothing that really indicated that they're getting ready to cut soon. Of course, they were going to talk about cutting at the December meeting because their summary of economic projections showed 75 basis points in cuts. They had to acknowledge it, but it doesn't mean that they're getting ready to cut soon. I still think that there's a wide variety of views on when they should even start cutting, and if they're not in consensus about when to start cutting, March is going to be too soon, and the economic data is just not going to be there either. 180,000 on payrolls is not screaming a rate cut in March.
You mentioned that variety of views. You see that in the dot plot, huge spread. Do you get a variety of views on client calls right now, or is it very one way? Just this market expecting cuts, cuts, cuts?
It's interesting. So sitting on the consumer side, you know, largely I talk to a lot of equity clients in addition to fixed income clients. I'd say the equity guys are very bullish. Of course, fixed income clients are a lot more bearish. So when we think about market pricing for a March cut, I would say some of those fixed income clients are actually pricing in a recession starting this year.
Wow.
Whereas equity clients have gotten really on board with the soft landing call, even though I would say a year ago it was hardest to convince them of our soft landing call.
You were early, that's for sure. It's great to catch up. Appreciate it. Happy New Year.
Thanks for having me.
Thank you for being here. Appreciate it. Sarah Wolf there of Morgan Stanley on this Payrolls Friday. If you are just joining us, welcome to the program. State of play, equity futures negative by 0.2%. Yields higher by 3 or 4 basis points. Your 10-year 4.03% on a 10-year this morning, Lisa. Yields just a little bit higher.
What a shocker.
Fixed income bearish.
Isn't it always the way?
Stock traders bullish. Yeah, but here's the weird thing. What if stock traders are actually ahead of the curve rather than bond traders, right? I mean, what if actually they're right, and they've been right actually more often than some of the bond traders that have been shifting around yields like penny stocks? I mean, at a certain point, you have to wonder, okay, all right, who's actually right?
It's just the nature of the asset class. It's an anticipatory asset class, and your whole job is to sell dreams of a better future, good stories, right? To sell stocks. That's always been the way, TK. It's no different now than it was years ago.
I strongly agree with that. It's always been a big argument I've had. Every single stock, from the itty-bittiest idiot Robinhood GameStop thing up to Apple Computer, you're always selling a story of the future. Every time.
This is probably the reason
People go, no, CFA this, CFA that. You know what? You're selling a story. Everybody needs an iPhone. That's it.
This is why I gravitate toward fixed income. You know, do you get your money back? Because if I come up with a story, it's going to be existential and angsty and problematic, you know.
How depressed should I be? And then you've got like the scale.
Yes, exactly.
Like
very
depression
depressed.
and fixed income.
It might be okay.
It's like that across Wall Street and every fixed income desk. 8:30 Eastern Time for payrolls. We'll catch up with former Fed President Bill Dudley, former Fed Governor Randy Krosner, Alan Ruskin of Deutsche Bank, all still to come. Coming up next on the tension in the Middle East and what isn't happening in the commodity market. Alan Wald of the Atlantic Council from New York. Good morning.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Like, just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think we can't just sit by and see shipping lanes in the Red Sea or the Persian Gulf stay undefended. This is a tinderbox with the Red Sea and the Persian Gulf being crucial for oil, and I suspect things may get more tense before they get better. So this will call for tough rhetoric at the very least.
Things are getting more tense. That was Greg Valliere, AGF Investments Chief U.S. Policy Strategist. The latest this morning from container shipping giant AP Moller-Maersk, saying it's decided that all vessels due to transit the Red Sea will be diverted south around the Cape of Good Hope for the foreseeable future. The quote from that company earlier this morning, TK, just to repeat that for people just joining us, saying it's encouraging customers to, quote, prepare for complications in the area to persist and for there to be significant disruption to the global network.
I wonder what government officials will say about this. You know, the many, many different nations involved, and of course, particularly the United States. Did Maersk make this decision in consultation with the Pentagon, just as a, kind of statement or that? I really wonder how the response will be from the government forces trying to protect all these ships in the Red Sea.
My answer to your question is, I'm not sure, it's unclear, I don't know. But I'll say this, Tom, based on what we do know, they've tried to prevent this from happening.
Yes.
And clearly failed.
Yes, there's
and
no
it may well
question.
take longer to address the issues.
We mentioned this earlier as well. You go back to the traditional wars of 1948, 1967 and on. There's nothing traditional here, as we heard earlier. We heard from Elliot Ackerman earlier this week. I mean, it's absolutely original what we're living in right now. We're going to get a briefing on this, and we're going to do this from the land of the hydrocarbon. Ellen Wald is definitive with her one volume on Saudi and on Saudi Arabia and the Saud family. We're thrilled that she could join us right now, senior fellow at the Atlantic Council. Ellen, just let me begin with a blunt instrument. Why hasn't the price of oil really moved?
Well, that is a very good question, and I think the answer is mostly U.S. production is very, very high, has been very, very high, and we're not seeing any kind of significant disruption in terms of supply getting to where it has to go, because the oil can be transported on these very large crude carriers, which actually can't even go through the Suez Canal. So I think we've definitely got disruption or potential disruption to the oil trade, but it's not as bad, I think, as people might have hoped. However, I do think that the potential for risk to oil supplies is growing basically every day.
If we can shut down the Red Sea, let's go, I believe it's east. Can we shut down the Arabian or Persian Gulf?
I'm not sure that would be quite as easy, but we can definitely threaten the safety of shipping in that area. And so I do think that this is almost a case study or a very important inflection point to see what is the international community, which depends on safety in the waters. I mean, we're talking about global international shipping. We're not just talking about what goes through the Red Sea, what goes through the Suez Canal, but these actions that the Houthis are taking are having reverberations all around international shipping. I mean, rates are up 88% pre-pandemic. Simply because of what we're seeing in the Red Sea. So this isn't just a local or isolated issue. This is having large-scale reverberations.
I saw your comments on this, Ellen, earlier this morning on Twitter or X, however you want to call it, where basically you were saying freedom of the seas is a global issue and that the Houthis' actions are going to have pretty broad-based ramifications. Given that, Ellen, why aren't we seeing Saudi Arabia, Qatar get on board with the United States to try to prevent these Houthi attacks?
The short answer is it's complicated, and the relationship between Saudi Arabia and Houthis and the UAE and Houthis is very complicated and is much deeper. And I think we haven't heard a lot about it unless you're really zooming in on the Middle East. I mean, the conflict between Saudi Arabia and UAE and the Houthis has been going on for a very long time. I mean, there were troops involved. UAE and Saudi were sending troops into Yemen for quite some time. There were missiles that the Houthis were shooting at Riyadh and that were finding locations there. We had Riyadh using some of the missile systems from the U.S. to counteract these missiles. And then eventually they kind of reached I don't know if you call it maybe a détente, where everything kind of cooled down. And I think that the Saudis and the Emiratis are really loath to re-engage in that conflict. Now, if the Houthis do threaten any kind of Saudi shipping or Emirati shipping in the area, then I think the pressure would be on them to get involved. And Saudi Arabia is particularly at risk because they have ports in the Red Sea between where the Houthis are and the Suez Canal. And those are pretty important ports and pretty important areas for them. So if the Houthis are able to threaten those ports, then I think that we would see them get involved on the side of the United States. But I think until that happens, there are pretty strong reasons keeping them out of this conflict.
Given all of these complications, which are dizzying to think about, when you zoom out, how do you put this genie back in the bottle? And if you can't, doesn't that mean that even with U.S. production, hydrocarbon costs have to go up really materially if not only shipping is interrupted, but also the shipping of those hydrocarbons?
Yeah, exactly. And we're not just talking about hydrocarbons that go through the Suez. We're also talking about hydrocarbons that go through the Sumed pipeline, because unless they're coming from Saudi Arabia, they've got to go through that Red Sea point to even get to the Sumed pipeline that is basically a workaround for the Suez Canal. So it's more than just transit through the Suez Canal. I do think Europe is going to see the biggest effects of this because they're getting a lot more of their oil from the Middle East right now, and they're going to be affected by much longer shipping times and higher rates as these ships are going around Africa. And I don't think we're going to see shortages, but there's definitely potential for higher costs. And if we see oil prices getting higher, then that will compound these issues. I do think that the United States is going to have to make a decision whether this is purely a defensive operation or they're going to go on the offensive to some extent and actually frighten the Houthis and show that there are real consequences.
Ellen, you've been studying the Middle East for years and years. You wrote the book on Saudi Arabia. A lot of people look to you for your insight about the kingdom and about the region. And I'm just wondering, based on everything that you've seen over the past couple of weeks, how much have the chances of an escalation really increased from your vantage point?
I do think that the chances are higher than we're seeing priced into the market right now. I think there are still very strong deterrences to seeing the conflict spread. Saudi Arabia does not want to get involved. It's not good for business to, get started in a war in the Middle East. It's not good for, the oil business to start any kind of conflict with Iran. But at the same time, we are seeing escalation that may not be able to be quelled unless some offensive action is taken by parties that aren't just Israel. Particularly if Israel starts to escalate the conflict into Lebanon, into something against Hezbollah, then we're likely to see just greater tension, greater potential for terrorism across the Middle East. We already have seen things happening in Iraq and in Iran, and so I do think that we're definitely at a higher risk of conflict than we were even in October.
With that in mind, just to put a bow on it, Ellen, how long would you expect these disruptions in the Red Sea to continue for?
I'd say they can continue for the foreseeable future unless this coalition decides to go on the offensive. This is a very low-cost, high-return event for the Houthis, and so unless their supply of weapons is cut off or someone higher up in Iran tells them to cut it out, I don't think that there's any real sign that they're going to stop.
Amazing. Ellen, thank you. Appreciate the insight. Ellen Wald there of the Atlantic Council on the situation in the Red Sea, really echoing what we heard from the container shipping giant AP Moller-Maersk a little bit earlier this morning. Looking ahead, TK, crude 78.20, WTI about 73. Ellen was saying it, not really priced in much risk there at all, have we?
Well, have we yet? And Admiral Stavridis, writing for Bloomberg Opinion, was heated about this. He didn't say, where's the offense? Let's go get them. There are many people saying that. But he said, what's the plan to shift from a hugely defensive characteristic in the Red Sea? Maybe now with this Maersk announcement, maybe we'll hear something into the weekend news cycle.
Crude positive by almost 1%, higher by about 0.75% this morning. Coming up very shortly, we're going to break things down with Nadia Lovell of UBS, looking ahead to the year ahead in the equity market and counting you down to payrolls. The report at 8:30 Eastern Time. Fantastic lineup for you. Randy Krosner of the University of Chicago, TK, Alan Ruskin at Deutsche Bank, Bill Dudley, former New York Fed president. I believe we'll catch up with Gina Martin-Adams as well. So that's your lineup, Tom, for the next 60 minutes or so?
It takes economics of the moment, all that we'll give you, and Mike McKee will give you at 8:30, and John, it folds it right into what's it mean for a market beleaguered.
The payrolls report are coming up very shortly. The estimate 175,000 in the Bloomberg survey. From New York City, this is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
The JOLTS data, the quits rate, openings to unemployment, all of this signals that there's a great normalization happening.
We are expecting a slowdown, to be fair. We think that we'll see a softer monthly growth.
We're looking for job growth to be settling here somewhere in the 150, 175,000 a month range.
This idea that we're going to grind higher in unemployment, that's something that I think we have to watch out for.
Business, the consumer, and the jobs market will play an important role this year. Key word to watch for is resilience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's Jobs Day. We'll see that here in 29 minutes. An interesting jobs report, and John Farrow to me, but everything is about here is everybody sort of thinks it's another normal December report. All my radars up in 29 minutes.
A new number returns to the screen. The number is 4 on a 10-year yield is 4.04%. Yields are higher again today, higher again yesterday, Tom, off the back of better than expected data. ADP came in stronger, jobless claims came in lower. That's the right kind of downside surprise. Will we get more of the same on payrolls in about 29 minutes?
And to correlate that over to this interesting discussion with Priya Misra, the real yield back up to 1.81%. There's been a real reversal in the joy of December, and you wonder, John, what aspect of the jobs report will move the reversal forward, a stronger, a worse equity market, I should say, or will it reverse it to the nirvana that we saw, say, December 15th?
Let's start with the headline number. So let's say 175, that's the estimate. 175 sounds pretty good, doesn't it? Unemployment below 4%,
yes.
If it stays there, great. Jobless claims close to 200K, fantastic. But when you ask economists, Carl Riccadonna, BNP Paribas, on this program in the last day, talking about beneath the surface, breadth, he's going to look at diffusion. How strong is the payrolls growth? How broad is that growth? Just a select few industries, or are we seeing it across the economy? And at the moment, there's a concern that you're seeing it in just a select few industries over the last 6 months.
And Lisa, what's important here is in diffusion is the signals given by the market, and one of them is a spread market where spreads have widened out. Does that indicate a tension on the real economy?
Well, it's the same story as you're seeing in the stock market. And as you guys were talking, I was thinking that there are two things that we're going to learn from today's labor market report. One is the granular economics that John was referring to under the hood, what we see in terms of the composition. The other is, where is the market over its skis? How is the market going to respond if we do get a 1, 2, and then 3 punch with better than expected labor market data with the non-farm payrolls capping it off? Do you see an escalation of the sell-off that we've already seen this week, both in bonds and stocks?
And that goes to say a 200,000 statistic or 220,000 statistic. Not many people are looking for that.
To Lisa's point, we've just turned last year upside down. So at the end of last year, stocks were rallying, credit spreads were tighter, the dollar was weaker, yields were lower. What's happening now? Equities selling off, credit spreads are wider, the dollar is stronger, Tom, and yields are higher. And we're just squeezing out a big position that was building up in a space of just 2 months. You think about where the 10-year Treasury yield was, 60 basis point move lower in November, 40 basis point move lower in December. We're talking 100 basis points, TK, coming into 2024, and a market just sort of locked onto this idea that rate cuts are just around the corner.
I mean, Nadia's going to come up here from UBS with a 51 SPX in the Uber Bull. Ed Yardeni said in his overnight note, which, folks, I really recommend you look at. Ed Yardeni's hugely accessible note, and the answer is, Lisa, is he says, it's a roller coaster, get over it. This is the normal market, is to have a roller coaster.
Yeah, it's a roller coaster that ends at, what, 6,000? I mean, this is Ed Yardeni who thinks that we're in the roaring 20s. It is a roller coaster, and yet what I think is interesting is that people are leaning into the roller coaster right now rather than a long-term bet because of the economic data being as mysterious as it has been.
John, I'm going to go to West Texas Intermediate, $73 a barrel, just off that Ellen Wald conversation. That was valuable.
Crude picking up just a little bit. Brent crude up by 0.9%. The broader price action, the scores look like this going into payrolls. Equity futures negative by 0.3% on the S&P, 4-day losing streak on the S&P 500, and about to snap, as things stand, about to snap a 9-week winning streak on the S&P 500. The longest weekly winning streak, Tom, going back to 2004 for the S&P.
Michael McKee scheduled to be with us here in 25 minutes. Randall Krosner, Blue School Chicago, the former Fed governor. Bill Dudley scheduled to be with us today, the former New York Fed president. We turn now to the equity markets. Nadia Lovell, senior U.S. equity strategist at UBS 5100 Global Wealth Management, joins this morning. Nadia, I'm going to go right into your research note within the compendium of our economics. You say earnings are, quote, skewed to the upside. Where does that enthusiasm come from?
You know, it's a momentum that we're seeing in the economy. I mean, since we produced our year-ahead outlook in late October, for clarification, the S&P is trending more towards our upside scenario of 5,100, and that's because the macro data has been coming in better than expected, with inflation coming down faster than expected. And if the Atlanta Fed GDP now forecast is correct in that sort of 2 to 2.5% range for GDP, and that continues into 2024, you could see some upside to earnings from there.
The upside here off a Q3 5 number, or 4 number, I should say, high 4, or that Atlanta GDP number, is that because of the American consumer? And does that American consumer enthusiasm fold into this morning's jobs report?
We think so. We think that the consumer remains in solid shape. Yes, you're seeing some areas of consumer stretch, but, you know, spending during the holiday season was pretty strong, and that should continue into 2024. Of course, it will be at a slower pace, but there aren't any signs that the broader consumer isn't holding in there. And inflation is coming down. You're seeing wage growth, so real income is picking up, and that should be a positive.
So, Nadia, some of the leading sectors going into year-end, tech was one, discretionary another. Is that where you're looking for leadership in 2024 as well?
We don't necessarily think that you're going to see a massive outperformance from tech like you did last year, but we do think that tech will continue to outperform. Now, let's put this into context. Like, yes, a great year in 2023, but pull back the charts, John, and tech is only up 5% over the last 2 years, and the Magnificent Seven only up 10%. So when you think about that also from a valuation standpoint, tech is trading at a 10% discount to where it was a year ago. So fundamentally, we think that the fundamentals have improved and tech can continue to outperform. But we do think that performance will broaden out this year to some of the more cyclical areas of the market, particularly if we can see that the Fed can land this economy into a soft landing and economic growth holds in there. That should help cyclical areas and also help small cap.
That introduces the energy conversation. I'm going to reference your note directly, Nadia. For Ferro, we're less bullish on oil. Nadia, talk to me about it. What's changed?
Well, yes. I mean, Brent oil did reach our $95 target in September. We thought it would hold. Clearly, that's not the case. You know, of course, yes, demand did surprise to the upside. We saw strong trend from China and India, but unfortunately, so did supply, particularly from those non-OECD OPEC plus countries like the U.S. And so when we look into 2024, we do think that you'll still get demand growth, just less slow. And we do think that OPEC plus will continue to try to manage supply, but we are not seeing such a massive deficit in the oil market in 2024, just a slight deficit. That won't be enough to push prices back towards $85, so down from the $95 that we had thought previously. And so we think that will provide a better off-ramp. And as you've been talking about all morning, I mean, yes, heightened geopolitical tension in the Middle East is not part of our base case, and that could provide some upside to oil prices.
What do you make of the fact that we were just hearing about how equity analysts are really leaning into this whole soft landing attitude, and then you've got the bond analysts who are talking about recession and are much more pessimistic? How do you sort of navigate that at a time where it does seem like soft landing is the base case for pretty much everyone in the equity world right now?
You know, it's not unusual for equity investors to be more optimistic than bond investors. But when you look at the data, I mean, the data is speaking towards a soft landing. I mean, we'll see what payrolls is coming in, you know, in a few minutes. But, you know, all indications is that the job market is holding up well. And so there isn't really any reasons today to be overly pessimistic. And so we do think that, you know, sort of 1 to 1.5% GDP growth for this year, and sort of reconcile that with inflation coming down faster than the Fed's target. I mean, our expectations is that you are going to see rate cuts this year, not as much as the market is pricing in. We're looking for 3 with the bias to 4 rate cuts for this year, and that will help to bring down bond yields and further support the equity market.
I'm going to make Stuart Kaiser fall off his chair, and Tom Keene's going to roll his eyes. But at what point is good news bad news? And I ask this because basically you're talking about how, you know, you want to see economic data that's good and that's going to support your bullish thesis. And yet, if you look at the bond world, which is more pessimistic, they're saying all of this good news means the Fed can't cut rates as much as people think.
You know, I think that, you know, at some point that you will start to shift to, you know, good news being good news and bad news just being bad news. Where that tipping point is still remains to be seen. You know, a lot of this is contingent on the labor market. But, you know, whether the Fed cuts with March or May probably is not that much of a big deal. It's 25 basis points difference. It's that the Fed that is going to cut this year. I think that's what's important, and that those cuts are likely to happen by around mid-year, particularly if inflation continues to decline. We all know core PCE 6 months annualized is at 1.9%, and so we'll be watching that very closely. If you can get a couple more months of below 20 basis points month-over-month increase, and that could pull forward the rate cuts at the end of the day.
Nadia, it is always great to hear from you. Thanks for catching up. Nadia Lover there of UBS Global Wealth Management. Happy New Year. Good to hear from Nadia going into payrolls. That data about 19 minutes away. Lisa mentioned Stuart Kaiser of Citi. I've got the quote from his research in front of me, so I'll read it to you on the data that we're expecting and how he thinks the market responds to it. Consensus expects payrolls at about 170K. The unemployment rate to rise to 3.8%. Average hourly earnings to grow something like 0.3% month on month. Stuart says this: we see that mix of data as positive for equity markets as it continues a trend of strong labour markets, Tom, with modest loosening and wage inflation on a downtrade. Now, that's one opinion, right, and that's Stuart's opinion going into payrolls in about 20 minutes.
Any unspoken here to my first question to Nadia is, what does earnings growth do? And I got too many people I respect, including Nadia Lovell, saying they just have it wrong. The gloom, the bad news, good news, bad news thing is wrong. Earnings growth is going to surprise optimistically.
That's not what's happened this week, though. Just want to point out that the good news has been bad news this week. So maybe people will say eventually good news is good news. I can't even keep saying this. Whatever.
You
And
can.
my point
Carry
is,
on, please. It makes perfect
I was going to
sense.
say, it's just I realize I sound ridiculous, but people are selling off in response to better than expected economic data.
Yields have been pushing higher off the back of some of this. If you are just joining us, here's the price action, starting with the bond market. Yields up on a 10-year, back through 4%, 4.05, higher by 5 basis points. The S&P lower by 0.3%. To Lisa's point, Tom, that's been a story of the week so far, just in the last 24 hours anyway. Better data than expected, pushing yields up.
Well, I like, what somebody said, we're January 5, so we're 370 days into 2023. I mean, it's just a continuation on, and at some point the year's going to start, and maybe the year starts in 13 minutes.
I think last year was a decade and a year. I think we can all agree on that, right?
Yes,
it felt like
early
a
on
decade and a year.
particularly.
A decade worth of price action in 12 months, didn't we?
It's felt like, a year and a week. So that's the reason we pushed this forward, right? We'll have a millennium by the end of 2024.
Randy Krosner joining us shortly, former Fed governor, to break down his thoughts on this Federal Reserve, what he's looking for from the FOMC this year, and what he's anticipating to see in the payrolls report as well. The payrolls report about 17 minutes away, and the state of play in financial markets, a little something like this. Equities up, yields higher. It's been the story of the week so far. Yields climbing by something like 15, 16, 17 basis points on a 10-year, and an equity market on quite a losing streak. 4 days on the S&P, 5 days on the NASDAQ, a 9-week winning streak. Guys, we're talking about the longest weekly winning streak going back to 2004. Tom, that's how good things have been. And I keep saying this. The weakness we've seen this week and some of the stats speaks to how good things have been over the last 2 months.
Yeah, and you wonder, are we on our way to a correction? And I would suggest corrections are a normal part of the market. You don't have to get all enthused by Yardeni's roller coaster. That's what it's supposed to be.
Randy Krosner, up next, a little bit later. Bill Dudley, former New York Fed president. Tons still to come. Your payrolls report, 8:30 Eastern Time. From New York, this is Bloomberg.
What does it take to be a great surgeon? This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
If we look at the hiring trend, it's been a very linear trend since the start of last year. Now, there is a slope to that line, and it's aiming lower. So there is a hissing sound in the labor market. If we're looking at non-farm payrolls averaging in the vicinity of 150 to 200,000, that's still a very healthy income and wage dynamic for the economy.
The brilliant Carl Riccadonna, good friend as well, chief US economist over at BNP Paribas, referring to the hissing sound, just some of the air coming out of the labour market, just a little bit. from New York City. Your payrolls report is just around the corner, 8:30 Eastern Time, 14 minutes away. You know the numbers by now. The estimate 175,000 in our survey, and the scores look like this going into it. Equity softer on the S&P, yields a little bit higher by 4 basis points on a 10-year to 4.04%. Equity futures, Tom, negative here by 0.2%.
Let's remember, Alexander Tansey in Washington is our best data guy. I steal from him every day, every week of the year. He does magnificent work. John, he sends in the standard error of the non-farm payrolls report. It used to be a quiescent 100,000, plus or minus 100,000. And he says with all the new regime and the pandemic and all, we're out near 130,000. So you can be 130,000 off on your job guess today and say, well, that's just part of the statistical error.
The spread between the high and low is about 155,000.
Yeah.
So the high estimate today is 235, Tom. The low is 80K.
Someone who knows the math, 1 over the square root of n, is Randall Krosner. He holds court at the Booth School in Chicago, the former Fed governor, understands the standard error. Randy, I'm going to go to where I was with Dr. Wong of Chicago earlier, the great Anna Wong, where she said, you know what, it's messy out there, and particularly the birth-death mystery of the Bureau of Labor Statistics. Do we have a clue how we count the labor economy? Or are we making it up as we go post-pandemic?
Well, I wouldn't go so far as we're making it up as we go, but obviously there have been some changes, some fundamental changes in the way people participate in the labor force, the way people work from home. And so obviously things are a little bit more difficult to track than they were before. But I think we have a reasonable bead on things. But as you said, you just said standard deviations are up a little bit. So sure, it's up, but I still think there's information content in it.
The information content is about half of America going, what does Krosner know? What does Key know? Farrell, Abramowitz, and the rest? And that half of America's flat on their back. You see it in some used car price deflation. You see it in rising bankruptcies as well. Can we aggregate our economy off today's data, or are there 2, 3, or 4 Americas?
Well, I think there are multiple Americas, but what the Fed has to do is look at the economy overall. Obviously, its policies can have more or less impact on different groups. One of the groups that has the biggest impact on is potential homeowners, but it does have to try to put all the pieces together to make national policy. Not always perfect, but it's what they need to do.
Are we creating the right kind of jobs, Randy?
I think we're creating good jobs. The challenge, I think, is making sure that people have the skills for those jobs. That's one of the challenges that we've seen over the last few years of this mismatch between what people, what firms want and what people have. And so making sure that we're investing in education, making sure that we're investing in the right skill set for people is crucial, not only for the job market for today, but also for economic growth over the longer run.
I ask this because a lot of people are talking about the composition of jobs that we're expecting to see today, whether it's the government officials who are going to necessarily play significantly into this, healthcare workers. I think about some of the service sector side that have been doing a lot of the hiring. Is this the kind of hiring that can sustain the kind of growth that we've seen in the U.S. economy over the past 12 months?
I think as we've seen since the pandemic, we've seen kind of waves of going in different directions. Everybody wanted goods, everyone wanted services. Obviously, healthcare is starting to grow, and so then tech is very important. Many of the tech firms cut back on workers, but there are a lot of tech startups, a lot of new areas that are coming in. So I think that's an area that we'll need to be very mindful of going forward.
What are you watching most closely? I know that you mentioned in some of your notes wages, and I've been looking at wages also. This idea that 3.9% growth in wages is not commensurate with a 2% inflation rate for the Federal Reserve. What do you see when you look under the dynamics of pay?
Yeah, I think that's really the key, because I think that's one of the key things that the Fed is going to be focusing on, not just the robustness of the labor market, but what does the robustness of the labor market mean for inflation? And that really is going to be filtered through wages. If wage growth is still very strong, that's really the key cost for most firms, certainly if they're services firms, but even for manufacturing firms. And so if wages are growing at 4 or 5%, to get inflation down to 2%, the only way to do that sustainably is have a big boom in productivity growth of 2 to 3%. we've seen some pretty good productivity growth recently. I don't know if that's going to be sustained, but that's really the key thing to focus on is looking at, or at least I think, looking at wages and productivity growth.
Randy, before we get stuck and drowning in the numbers that we get in about 8 minutes' time, what are your thoughts on the communication from the Fed we've had over the last month or so? It felt like the chairman was pivoting towards a conversation about rate cuts in the near future. Minutes kind of said something else. New York Fed President John Williams certainly said something else. What was your take on it all?
Yeah, I think Jay may have gotten a little ahead of his, a little over his skis, or whatever the metaphor is, on getting people excited about rate cuts coming too soon, because I don't think that's where the consensus is, and I don't think that's exactly where Jay wanted it. Jay wanted it to be. I think, as you said, there's a lot of pushback from a number of the Fed speakers that, well, hold on a second, this doesn't mean that we're starting to cut in March, or but we are on a path over the year to cut, and I think that's right, and I think he had exactly the right message there. But I think markets got a little bit too excited, and I think the minutes helped to clarify that.
A lot of people feel the same way. Randy, stay close. You're going to stick with us, I'm pleased to say. He's going to respond to the payrolls report in about 7 minutes' time. Mike McKee's going to break that down for you. Mike McKee is alongside us in a radio studio. Mike, talk to us about it. What are you looking for in 7 minutes?
Well, right now, the forecast is for 175, which is a reasonable number given the inputs that we've had from other data sources. Anything between 150 and 200,000 would be considered a strong number. Go below 150, that's when I think you might get a market reaction to the idea of when the Fed will be cutting rates. You get down to 100,000 and the Fed would not be concerned, but the markets would probably panic in that case. 3.8%. That's just a tick up for the unemployment rate. The interesting question that has been in the markets for a while is, when do we trigger the SOM rule? It isn't going to be today. You'd have to go up to 4.4% today,
interesting.
Which would have its own implications in order for the SOM rule to be triggered and recession be forecast by unemployment.
Mike McKee, what's the greatest aberration of December? I mean, the tradition is it's retail shopping, but come on, Amazon blew all that up. What's the countability oddity of December?
We don't have the same oddities as we used to, Tom, because a lot of the temporary hiring that takes place for the holiday season has moved earlier into October and November. There has been a shortage of workers anyway, so we may not see the kind of give back that otherwise we would. January has traditionally been the month where you would see the layoffs of all the holiday workers, and that's not been happening. The question is, do we see any changes in any significant other categories? Did restaurants put on more people because people were going out to celebrate the holiday season? That kind of thing. But we don't really have an oddity anymore in the holiday numbers once they're seasonally adjusted.
Mike McKee is going to be with us in about 5 minutes' time. Mike, stay close. Mike McKee standing by. Bramo 175 is the headline estimate here. Unemployment, as Mike suggested, 3.8%. That's the estimate, 3.7 previously. Then you've got the wage growth, 0.3%, and a ton of other indicators as well. What are you looking for?
What I'm watching is wages, and I'm watching the revisions. I think that really, if you see wages tick up more than expected, that's going to really be the cap to what already has been a good news is bad news type of week. As far as the headline number, I feel like every month we sort of get this sort of response, the knee-jerk response to the headline number, and then you sort of take a look beneath the surface, and those are the indicators that really drive action.
On weekly claims, I look at a 4-week moving average, which is a Bloomberg function. That's the one that I've memorized, INJC, JC4. And here I'm going to look at the 3-month average. Lisa, to your point on revisions, you take the immediate revisions. We'll do that math for you. But then I want to look back at 3-month non-farm payrolls. What did it do in the last 90 days?
What a fantastic lineup through the next 30 minutes. We'll break things down with Randy Krosner, the former Fed governor, and the former New York Fed president, Bill Dudley, just around the corner as well. All of that still to come. Your payrolls report up next. The scores look like this going into the data. Equity futures negative, down by 0.2%, and the S&P 500 on a 4-day losing streak. The data up next.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Payrolls report about 20 seconds away. The scores going into it in financial markets. The S&P looks like this. Equity futures on the S&P slightly negative by 0.2%. On the NASDAQ, down by 0.2. Negative 0.25% on a 5-day losing streak, potentially making it day 6. In the bond market, going into that jobs report, yields higher on a 10-year by 3 basis points, a little more than 4% on the 10-year. With your jobs report, here's Mike McKee.
Well, we got a strong one, guys. 216,000 jobs were created in the month of December, according to the Bureau of Labor Statistics, and the unemployment rate stays unchanged at 3.7%. So strength in the labor markets. Average hourly earnings were up 0.4. The forecast was for 0.3. And so average hourly earnings on a year-over-year basis go up to 4.1% from 4%, certainly higher than the 3.9 that had been forecast. So we definitely get a surprise in the numbers here. The 2-month net revision, however, is negative 71. So we are seeing a decline in the number of jobs that were reported in October and November. For December, or for November rather, the number was 173. Remember, it originally reported as 199. Change in private payrolls, very strong. This is interesting because a lot of people have been talking about government hiring driving this. 164,000 of those 216 are on private payrolls. That's up from 136,000 the month before and well over the 130 that had been expected. Manufacturing payrolls come in up 6,000, just 1,000 more than forecast. That's down from 26,000 the month of November. Labor force participation rate falls to 62.5, and average hours worked falls to 34.3. So very strong report considering the circumstances, and I'm sure. Well, I'm going to bet there's a market reaction.
Yeah, Mike, I think you can guess in which direction. Mike McKee, thank you. Rate cuts. What rate cuts following this one? Let's get to it. Equities down, yields up, dollar stronger. Equity futures on the S&P 500 near session lows at negative 0.5%. Yields are higher across the board, up 10 basis points at the front end on a 2-year, 4.48. On a 10-year, up by 9 basis points, very close to 4.1%. On a 30-year, further out along the curve, up 7 basis points, 4.2230. Yields up, Tom. Dollar stronger. The euro negative, and taking out 109 and dropping to 108. 108.84 on euro dollar, negative by 0.6%.
And on a global base, you should see it in the yen dynamic, tangential to the labor economy report, but a solid 0.9% yen weaker move right now. John, what I see here is Anna Wong is brilliant. 216, take out the 71 revisions. You got 145,000 is a summed statistic with the revisions for this non-farm payrolls. And then the other thing clearly is the wage inflation is there.
Headline number 216,000 against an estimate of 175. Wages hotter than expected. The unemployment rate stays at 3.7%. Mike McKee, I want to bring you back into the conversation. Before these numbers drop, we talked about breadth. How broad-based were these job gains? What do you see beneath the surface?
Basically, it looks like it's reasonably broad-based. We had healthcare adding 38,000 jobs. Of course, that's the category that is always in need of workers. Social assistance up by 21,000 as part of that. Construction employment up 17,000. That had been a weak point in recent months. Builders looking for workers because there's such demand for housing these days. Transportation and warehousing dropped by 23,000. That's interesting because couriers and messengers were down by 32,000, and this is the month. If you drove around New York in December, you couldn't get up and down the street because there's a delivery truck parked everywhere. So it's interesting that there were fewer jobs this time. Leisure and hospitality, as always, adding jobs, 40,000 jobs, an average of 39,000 for the whole month, the whole year of 2023, and retail employment was up by about 17,000. So we're basically looking at a fairly broad dispersion of the number of jobs created. Oh, I should mention I was wrong. Government employment was the biggest change, up 52,000, most of that in state and local, not federal. But we did see a very strong month in December. I think Tom's point is good, though. The revision, you take the revisions out, you have a weaker overall number, and we'll have to see if the December number gets revised down when we get to February.
Early days. Mike McKee, thank you. We'll see if this move sticks, but ultimately, Elisa, taking a bite out of rate cut bets for March, that's for sure off the back of this one.
I'm just still focused on the wage increase that we saw. The 4.1% year over year is exactly in the wrong direction. What's interesting to me is that there are signs of weakness in an odd way. Participation rate went down, 62.5 from 62.8, and the underemployment rate actually ticked up. So not necessarily consistent. It's still early days, but consistent with this incredible efficiency. Everybody's coming back to the market, kumbaya, immaculate disinflation.
The initial reaction, stocks down, yields up, dollar stronger. Let's get some reaction from Randy Krosner, former Fed governor, now professor of economics at the University of Chicago. Let's talk about it, Randy. Your first reaction to this one?
So as we were saying before, I think the Fed focuses a lot on wage growth, and we've seen wage growth above expectations. I think it's really clear that the Fed is going to be waiting a while before it starts cutting rates because the labor market is still quite strong. The wage growth is still quite strong. And wages are the key thing that then feed into services as well as manufacturing inflation.
Randy, not the simple arithmetic of a real wage, but almost just a cultural and societal note. Do you see here wage growth being beneficial across America and that people will have more inflation-adjusted cash in their pockets?
Oh, it's super great to have real wage growth, finally. I mean, we had, even though nominal wages were growing very rapidly, they weren't growing as fast as inflation. And so people were feeling left behind. And they were left behind because they wanted to put food on the table for their families, and the food was a heck of a lot more expensive than it was before. Now they're starting to earn a bit more than inflation, which is great for them. But I think what that's going to mean over time is that, well, when it was great to be hiring people when labor was relatively cheap in real terms, now I think you're going to start to see a little bit of softening of the labor market because it's just not going to be as worthwhile for firms to be hiring when workers were relatively more expensive.
Randy, why is it that we've seen so many downward revisions of the prior months? Does that mean that we can expect a significant downward revision of this upside surprise come the data that we get in February?
Well, this gets back to what Tom was talking about before. The standard deviation has gotten wider. So there's a lot more noise that's in there. I don't think you can take something specific out that it's always going to be downwardly revised. I think we just know that there are going to be some substantial revisions.
Hey, Randy, appreciate the update. Some revisions to some forecasts as well for rate cuts maybe after this one. For anyone penciling in March, I think there's a rethink following that, especially if we get another one of these for this month, next month too. If you are just joining us, hot jobs report, 216,000, the estimate 175. Unemployment, the estimate, we were looking for that to climb from 3.7 to 3.8. It stayed at 3.7. Takes a while to read through all of this. Mike McKee's alongside us breaking it down. Mike McKee, what do you see in the labour market report on a second, third, fourth look?
Well, if you're going to look for some bad news, John, you might look at unemployment. Unemployment was unchanged at 3.7%, but that's because there was a big drop in the civilian labor force, falls by 676,000, and hiring dropped in the household survey by 683,000. Only 6,000, though, were unemployed. So it looks like a kind of an odd balancing of the household survey inputs to unemployment that suggests maybe it's not as strong, at least on the employment side, as the overall numbers show. And the other thing people were looking at was the revisions to the unemployment rate last year. There were some expectations that it could move the needle on something like the SOM report if we got higher unemployment rates last year. It's that are always revised in December, and it comes out. The only month that was revised was October, down 0.1%, and the rest of the year was completely unchanged.
Mike McKee, thank you, sir. We'll get a final word with Mike before the end of the program, before the end of this hour. Equity futures on the S&P going into the opening bell at 9:30 Eastern time, lower, near session lows, down by 0.5%. The Nasdaq 100 off by 0.5 as well. The Russell, the small caps, getting absolutely hammered. We're down 1.4% there. Yields are higher by 8 basis points, 4.08%. And in Alan Ruskin's world, the dollar is stronger, the euro's weaker. We've broken 109, 108.96. Alan Ruskin at Deutsche Bank joins us now. Alan, good morning. Happy New Year.
Morning.
Let's get straight into it. What do you think of that one?
Yeah, well, it's certainly good news as far as growth is concerned. A little bit more worrying as far as the underlying inflation picture, with wage inflation in particular. I think one thing the market should take into consideration is that the state of the economy in December was reflecting tightening financial conditions from months earlier, probably more reflective of a bond market at, say, 10-year to 5% yield than a 4% yield. So there's a lot of stimulation that's still going to come through that's going to be supportive for the employment reports coming forward in Q1 and Q2.
We're misguessing GDP. Third quarter was a shock, 5, maybe now revised down to 4.x%. We're hearing that fourth quarter may be the same, or diminished, but still the same. Are we just misguessing the strength of the American economy off this jobs report? Is it just simply better than we expect?
I think it's been simply better than we've expected for more than a year. I mean, you just look at the employment report misses. There are very, very few downside misses in terms of the forecasting. So there's a pattern here of underestimating the strength of the U.S. economy. I don't think that this is that different, really. The nowcast Q4 GDP numbers are, close to 2.5%. Certainly, when we're looking at the data, we're anticipating that if there's going to be genuine weakness, it's got to start showing up in the first half of this year. And that's the highest probability in terms of negative growth.
Are we misjudging too weak a dollar? That seems to be the zeitgeist now. I know you're pushing against that, but
no, I think that's certainly true in terms of the short term. I think what we're seeing for 2024 so far is this pushback in terms of rate cuts for the first half of the year, second half of the year as well, and the dollar is just a reflection of that. And we're seeing some pretty big moves now. I think the biggest question mark is really over dollar yen. A lot of people have anticipated that this is the year of the yen. It's, I don't think, going to be the year of the yen, at least in the first half of the year.
Well, we can talk more about Bank of Japan policy another time. I am curious, though, with respect to rate cuts, you were forecasting quite a few in the back half of the year, not necessarily starting in March. If this continues, you said we have to see weakness in the first half of the year. When do you revise your call? And maybe don't call for as many rate cuts and actually get incredibly bullish on the dollar versus the euro and a whole host of other currencies.
Yeah, so I mean, this be a sort of something that my colleagues, Matt Lizzetti in particular, would revise in terms of any sort of reconsideration. I think if you had the first quarter generally put up some solid numbers, these kinds of numbers, you'd really have to question whether the economy is slowing down materially at all. And I think the Fed's bias has still been, if in the very short term they could still hike rates, that could still come back on the table. I think, that's leaping ahead a long way, but certainly taking back rate cuts is a relatively easy call, as per what John said in terms of March. I think looks, that 2/3 probability of a rate cut that we had effectively before this data looks exaggerated to say the least.
You mentioned some of the big moves we're seeing. I just wonder whether we're learning more about market positioning than we are the US economy. Which one is it?
I think a lot of what we saw in November and December looked like a real squeeze of positioning and an exaggerated move in relatively thin markets. And people obviously wanted to judge and jump on what is seen as a sea change, move from rates no longer going up. And I think that made sense. But then the market just got ahead of itself, and now we're in retreat.
Can I ask you, and particularly off the back of data like this, I think it's worth asking. I have no idea where we're going here, absolutely no idea. But I think the overwhelming consensus is not just cuts. Even the people who don't think you get cuts anytime soon, they think this Fed is absolutely done. Is there a chance they need to hike interest rates again, based on information like this?
I would say that if you were flatlining consistently and you still had wage inflation running at these kinds of levels, then the Fed would have to think in terms of whether they could get inflation all the way down to 2% in a reasonable time frame. But I think we're quite a long way away from that sort of reconsideration of rate hikes, but it's not totally without, out of the realms of possibility.
Well, what John said there, I want to pick up on this idea that are we learning more about market positioning than the economy, especially at a time where every month the previous month's data gets revised so significantly, and you have seen that sort of gap increase over time. Does that make you less confident in these numbers? Do you sort of not look at these numbers as much as you do the 3-month rolling average that looks perhaps less rosy than this one?
Yeah, I think you've got to take a very holistic view of all the data as such. So it's, obviously not just the employment report, although I would still say it's the #1 release. Absolutely. Look at the 2-month, 3-month, 4-month moving averages. Look at things like the diffusion index, which has shown that the breadth of employment growth is narrowed over time. I would still say the labor market is slowing, that all the underlying dynamics that we've seen in things like the quit rate, for example, the openings data to some degree as well, does suggest that the breadth of employment is weakening.
Just real quick here, do you think that the accommodation that we saw in the market that actually effectively gave a rate cut to the market over the past couple of months, do you think that that turbocharged the economy on the margins?
I think it's going to turbocharge the economy, and I would say it's much more than one rate cut. If you have a 100 basis point reduction in the 10-year yield, that's going to equate to 150 basis points, at the outside 200 basis points of Fed funds rate cuts. So there's a lot of potential stimulus that's going to kick in, and obviously spilt over to other financial conditions as well. So the equity market is going to keep that wealth effect on the consumer side buzzing as well. So there's a lot of stimulus there.
What a start to 2024. Alan, thank you.
Thank you.
Really good to see you. Alan Ruskin there of Deutsche Bank. Let's turn to the price action, shall we? And the economic data. The number, 216,000, the estimate, 175. Unemployment came in at 3.7%. We were looking for that to climb higher to 3.8. Wage growth, hot. TK 0.4%, the estimate 0.3. Year over year, if you want that, 4.1%.
Yeah, the wage growth is a key determinant. We said that earlier as well, but I'm already staggering forward. John, we've got to get out to, what is it, February 8th, early February to get the revision report on this statistic. The revisions got my attention, negative 71,000.
Sure.
Is that weight that's out there that shows a slowdown.
This is the calendar. The payrolls report just behind us, about 15, 16 minutes ago. In front of us next week, the CPI report, the end of the month, we'll hear from the Federal Reserve. Equity futures pulling back by just 1/3 of 1% on the S&P, but we are rethinking the Fed's next move if you were indeed looking for that to be a cut, and sometime soon. In the bond market, on a 2-year yield, higher by about 6 basis points, on a 10-year, up by 7. Really pleased to say that joining us now is Bill Dudley, Bloomberg opinion columnist and former New York Fed president. Bill, you've had the benefit of about 17 minutes to go over some of this. What's your reaction to it?
I think it just reinforces the notion that the Fed's not going to be in a rush to cut rates. So the last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force, and I think that this just reinforces that. The economy is still doing pretty well. Looks like we're going to have growth in the fourth quarter of 2% plus. Financial conditions have eased a lot over the last couple months. So I think that risks are that the Fed's going to keep rates higher for longer.
Bill, an unfair question. Why is the economy doing well? Is it productivity? Is it a follow-on of pandemic stimulus? What's the why of what we saw in Q3, what Atlanta GDP says about Q4, and maybe a few people optimistic about the first half of 2024?
Well, I think the biggest thing is that there were such large fiscal transfers that occurred during the pandemic that households and businesses are actually in pretty good financial shape for this late in an economic cycle. And so people have the ability to continue to spend. This is unusual. Typically what happens is people get over their skis, they're overextended, Fed tightens, and that actually bites quite a bit on economic activity. This time, I don't think people are as overextended, and so the Fed rate hikes have had less restraint on the economy.
Given that, Bill, and especially since you said the Fed's not going to be in a rush to cut rates, do you think that the market is still pricing in too great of a chance of March rate cuts if they're talking about a 50% chance right now?
Yeah, I do. I think May is more likely. I mean, if the Fed wants to cut rates, I mean, they've made it pretty clear that they view that as inflation falls, monetary policy is being tightened, and so that they need to follow inflation down. But to do that, they also have to get some signs that the economy is slowing sufficiently so that there's enough slack in the economy to bring inflation all the way down to 2% and keep it there. The wage trend obviously is something that's going to concern them. If wages are rising faster than 4% a year, that's probably not considered 2% inflation in the medium term.
Given that, and given the fact that we are seeing the rate cuts being priced into the market more than you think is warranted by the Federal Reserve, how much do you think it set them back, the Fed officials, that the markets did rally as much as they did into year end? How much do you think that, I'm going to ask you the same question I asked Alan Ruskin, how much do you think that turbocharged the U.S. economy?
I don't think it turbocharged the U.S. economy that much. I mean, the easier financial conditions just haven't been in place for that long. It's really only been a couple months. But I do think the Fed is a little frustrated by the fact the market always wants to be more dovish than the Fed wants, because that makes the Fed's job more difficult, because as the market rallies, that eases financial conditions, that adds impetus to the economy, which means that there's more for the Fed to do rather than less. So I think they're a little bit frustrated. Powell was asked about this in his last press conference, and he basically said, yes, at the end of the day, though, that these things have to come together. What the Fed does ultimately determines where the Fed markets are going to end up. And so the Fed does hold the whip here, and they'll get their way. And I think the way they get their way is they'll just be slower than what the market expects.
Bill Dudley, I've got to do an acclaimed surveillance audible and look at the celebration by you and the New York Fed over Dr. Musallam joining the St. Louis Fed. Bullard was always, with great respect to the gentleman from Indiana University, an outlier. His dot plot was always unique. What kind of dot plot are we going to generate with Alberto Musallam taking over at the venerable St. Louis Fed?
Well, I don't have a really strong view that Alberto is going to, be dovish or hawkish. I think he's going to take the information as he sees it and respond accordingly. I think what he brings to the Federal Reserve, though, is the fact that he not only is he a really good economist, but he also understands markets really deeply. So that combination of macroeconomic knowledge and also market experience, I think, is pretty rare in the Federal Reserve system. So he brings a great tool set to the Fed.
Yeah, I look, Bill Dudley, also, just within the crush of the jobs report, we have to look at your really spirited essay on not the fragility of our banking system, but just the idea of where we're going in 2024 and shoring up the supervision of our banks. Are you optimistic we can get that important job done?
Well, I think that it's pretty clear based on events that happened last March that supervision needs to do better. They need to be more forceful in forcing banks to remedy problems more quickly. But one way I think that to do that, though, is to actually release some of these supervisory findings that currently are secret. If you knew that the supervisory findings were going to come out with a lag of, say, 6 months or so, that would create huge incentives on bank managements and banks' boards to get going to remedy the problems. Right now, a lot of these problems are not known by people in the marketplace. And I think that makes it easier for the banks to sort of delay and not proceed as quickly as they need to do to remedy their problems.
Bill, fantastic column that came out from you earlier this week. Appreciate it. Bill, I just wanted to squeeze one further question in, if I can. Bill, you've been ahead of the curve big time on how far this Fed would have to go. Do you think there is still a risk that they have to move again, that another hike could be in our future?
I think it's pretty unlikely. I think that the bar to raising rates again would be, they have to totally reevaluate their whole framework. I think more likely.
In wages, it's kind of across the board. Mining up 0.5%, manufacturing up 0.5%, durable goods manufacturing up 0.7%, service providing up 0.5%, retail up 0.8%. So everybody was getting raises for the most part during the month of December, which is kind of interesting. But then the idea that maybe we're seeing a slowdown and things are going to get worse is belied a little bit by the unemployment news, because when you look at the categories of unemployment, white unemployment rose by 0.2, but black unemployment fell by 0.6, Asian by 0.4. So you're looking at the people who usually are last in, first out, and you would expect to see their unemployment rate go up if things were getting worse. They're not for them. So it's kind of an interesting situation that it kind of leaves you still scratching your head about where we go from here.
I think we've been doing that for a while. Mike McKee, thank you, sir. Fantastic job this morning, as always. On the surface, things look decent. Beneath the surface, Mike McKee says things look decent. Let's get you set up for the opening bell in about 36 minutes' time. Equity futures pulling back just a little bit, but recovering. We're down by about 0.2% on the S&P 500. We've been selling off all week on the S&P 500. 4-day losing streak on the S&P, 5 days on the NASDAQ. Yields a little bit higher this morning, up by 5 basis points, 4.43 on a 2-year. To get you ready for the opening bell, Gina Martin-Adams, our chief equity strategist for Bloomberg Intelligence, joins us right now. Gina, good for the economy. Is it good for the equity market? What's your take on that?
Yeah, the equity market is unfortunately in a bit of a sticky spot here to start 2024. We've been in a corrective process from an overbought condition where we ended 2023. So the backdrop headed into this report was not particularly conducive to gains for the equity market to start with. And then I would suggest the report is likely to have mixed results on the equity market. Remember, the consensus view is for slower growth and slower inflation headed into 2024. So while this is definitely a positive sign for growth, it's also a potentially inflationary signal with the wage numbers that were significantly above expectations, still above the 3.5% bogey that I think the Fed is watching on wages. So that mixed result is probably net negative for the equity market, considering the backdrop.
Gina, moments ago, Atif Malik at Citigroup just pushed against the gloom on Apple. He said his channel checks are good. He's got a 27% total return on Apple out. I don't want you to speak specifically about Apple, but I want to speak about what I've talked about all week, which is the acclaimed Martin Adams optimism on earnings growth right now. What does the gloom crew get wrong?
Well, I mean, I think, frankly, the expectation embedded in markets is far too bearish. I mean, as much as the consensus is saying we're likely to get about 11% earnings growth, our macro model says that the market expectation is closer to 0% earnings growth for 2024, which would be nearly unprecedented considering that earnings fell a touch in 2023 to have 24 months of negative earnings growth on the S&P 500 as inflation is decelerating. Is a really tough call to make, but that's what's priced in stocks. And this is what I mean when I say growth expectations are very, very low. No one is expecting acceleration in GDP growth, nor is the market apparently expecting much acceleration in earnings growth next year. But if to the degree that you are optimistic about earnings, you are somewhat reliant upon the inflation deceleration continuing. Where we get some degree of earnings optimism is not that we're expecting a remarkable recovery in revenue growth, but that margins are continuing to improve because inflation is decelerating. Companies are becoming more efficient. They're continuing to cut costs across the board. They're generally very lean and ready for any incremental revenue improvement. So you have a lot of upside potential surprise on the growth line. I just don't think that the market is expecting anything there. But you also have some potentially stickier than expected inflation, which could scupper the view a bit.
Gina, just real quick here, how much does the wage gain that we just saw in the employment report really challenge that margin question?
Not much, Lisa, because wages are only a small percentage of overall operating margin changes in the S&P 500. Where we're getting the greatest degree of our tailwind is because import prices are falling, producer prices are falling, and that's allowing companies some degree of pricing power. We've not had much net improvement in wage over the course of the last 18 months. So I would certainly love to see deceleration in wage growth as a component of potential margin expansion for companies over the course of this year. You don't want too much, obviously, because then it ultimately eats into the top line. But we'd like to see a little bit of deceleration to help boost the margin story. Yeah. But it certainly has not been part of the tailwind so far. So I wouldn't say it's a huge risk to margin growth. It just could become a tailwind over the course of the year.
Gina, great to catch up. Happy New Year. Gina, Martin Adams there of Bloomberg Intelligence following the payrolls report. TK coming in a bit stronger. Equities taking it okay. We've had a string of losses. Futures down by 0.2% on the S&P.
We started with Steve Whiting of Citigroup this morning, and he said exactly the same thing, maybe in a different way, but the same vector direction of Gina, Martin Adams. There's a gloom out there about corporations. Witness the weak Apple gloom that we've heard from Barclays, Piper Sandler, and others. And the bottom line, John, is just simple. These pros and equities are saying earnings are too negative right now.
JP Morgan results up next a week from now. We've had a drip feed of decent data, ADP, jobless claims, payrolls, CPI about a week away. On the open in the next hour, Rick Reeder of BlackRock, Michael Collins of PGIM, Anastasia Anaroso of iCapital from New York City. Good morning.
From New York City for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. So you've had your hot jobs report, yields spike, stocks drop. The countdown to the market open starts now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Coming up, U.S. payrolls come in hot, hot, hot. And with the next inflation print just around the corner, traders continue to pare their rate cut expectations. We begin with the big issue, Jobs Day in the USA. We have payrolls, December payrolls.
The first big test of the market. There is a hissing sound in the labor market.
On whole, the labor market has held up pretty resiliently.
We're not too concerned about labor market strength.
I don't think that the labor market is going to reignite.
The course we're on is where hiring will slow and slow and slow, and the unemployment rate will gradually tick up.
Continued slowdown in payroll gains, but hopefully not too drastic.
Labor market holding in well, maybe easing, but easing very slowly and gradually. And frankly, that's what the Fed wants.
The market stays dependent, the Fed stays dependent.
When you look at where the Fed is right now, there really isn't that consensus for a March rate cut.
There has to be some sort of data reality check for the market.
I do think that the bigger risk is the inflation.
Next week's CPI number could be very influential in that market pricing on rates.
We're looking for data that ratifies that view that we're getting a soft landing.
The jobs market will play an important role this year.
Bloomberg's Mike McKee joins us now with the breakdown on the latest report. So, Mike, there's no sign of a hissing in this economy. The force is strong. The jobs report looks robust on first take. Good day.
Yeah, the air is not coming out of the balloon, at least not yet, for the labor market. 216,000 jobs added. How strong is that? Well, you got to subtract the 71,000 revisions to October and November. So it may not be quite as strong as it appears, but when you have an unemployment rate that sticks at 3.7%, that tells the Fed something. We did see that number not go up as forecast because there was a big drop in the labor force. So not necessarily the best reason for that, but it still keeps unemployment very low. Average hourly earnings are the story of the day, up by 4.1% on a year-over-year basis. The thought was that they would fall back. Most of the jobs created in the categories that we have seen them being created in over the last 6-8 months: healthcare and social assistance, government, leisure, and hospitality. Interestingly enough, couriers and messengers lost 32,000 jobs. Those are the people who are dropping off all of your holiday presents for Hanukkah and Christmas, so it's kind of unusual to see that number there. Employment services down 29,000. Now, some people are going to say that is a warning sign because usually if they start to lose workers, then hiring is going to slow down. Let's go back just a second to the the average hourly earnings number, up 0.4 on the month. The expectation was for 0.3. And what you have there basically is a very broad set of pay increases across many different industries. And the problem is that the Fed's got to look at that and say, is this going to cause anybody to start raising their prices because they need to cover that loss? So we'll see what happens with that. And as you can see there, what we've got is the markets thinking that the Fed may be cutting back on the number of rate cuts, but it's the timing that may change the most today, Manus.
Yeah, well, we're certainly seeing a shift higher. Mike, thank you very much. In 10-year government bond yields, 405 is where we trade at the moment. Let's take the conversation to a veteran of the jobs report. It is BlackRock's Rick Reeder. Rick, good to see you again. This is hot. This is better than Some Like It Hot, and that just closed on Saturday night on Broadway. So first take, what goes through my mind is this sets the bar much higher for an immediate rate cut in March. Good morning.
Good morning. Thank you very much. And a veteran sounds better than older. So I'd say a couple of things. But it's solid. I think what Mike McKee described it. It's a solid report. I mean, you break it down, and we talked about it on this show a bunch. If you look at the breakdown of this thing, you have a different economy than we're used to. You look at healthcare and education. That is a demographic. That is a changing service-oriented economy. That's just hard. We're going to have sticky job growth. The thing that I think, though, if you step back and look at it, it's trending down a little bit. It's a little softer. You look at things like temporary hiring coming down a little bit. You look at the JOLTS report we got this week, professional business services coming off a bit. So listen, I think you have to characterize this as solid report, as Mike said. Average hourly earnings, by the way, the month-on-month was 0.44. It's a pretty strong number, meaning there's demand for labor. I think the paradigm that you have to describe in terms of economy, markets, certainly employment, is when people say, gosh, this is, we're going into recession, deep recession, it's just not evident in the data. The data is solid, and you got consumption buoyed by what is low unemployment rate, still good wages, and it's still a pretty good employment report. So again, slowing economy, and it's certainly illustrative in terms of this, but gosh, certainly not falling off the cliff anytime soon.
And here is the conundrum, as you say, it's different this time. There was another cross-asset allocator who I've known for many years. He said this to me in the IB. This is a unique cycle, and unless the Fed and others have recently made a dramatic change in where they see the long-term neutral rate, their modus operandi should be to cut and normalize and get us back to 3 to 3.5 over 18 to 24 months. That's just longer and perhaps not as low as the market wants. It is a unique cycle, isn't it? We've not lived through a post-pandemic. I mean, I've been around a while, but I've not even lived through a pandemic. But, it is unique.
So, I mean, couldn't describe it any better than the way you just said. So actually go back. Let's put this in perspective. You go back and you look at GDP in 21, we ran 12 nominal GDP. Then we got 7 in 22. Then we slowed down in 23 to 5.5 to what are we, 5? We're going to be 5.5-ish. I think this year you're going to slow to 4. This is not a classic. We ran too hot. The economy was running at 12 out of 10, created inflation. Now I think we're getting back to a normalized economy. And I would say one thing that I would challenge about where the Fed is. Listen, I don't think the Fed's going in March. I've said that before. I think it's crazy. They can't move. I don't think they'll move that quickly. But I do think they'll get the long-term funds rate down. I do think it'll get closer to 2.5 to 3 over time. The question is, how long does it take to get there? Listen, I think part of why I think you can start owning interest rates. This backup is great. The market got way too ahead of the Fed. Now you're backing up to levels that are starting to make some sense again. I'd love to see them pull back even a bit more. And I think when you think about where we're ultimately going, I think we're ultimately going to 2.5 to 3. It's a question of when we get there. I think they'll start cutting in May, June, and then I think they'll get there. With the 18 months, I wouldn't argue with that, but I think to a slightly lower trajectory, consistent with potential growth being lower over the next couple of years.
So I like your narrative, which is follow us, jump in. And what you say is, look, I can have a bigger splash if I jump off a higher diving board. We've had a small retracement is how I would categorize it, 10, 12 bips. How much more of a backup in yields do you expect? And where is perhaps a better re-entry point on treasuries, first of all? We'll come to credit very quickly.
That's a great question. So I think, by the way, we've made a good move out in the belly of the curve, out to the 10-year point. I don't think we're that far away. Would you be really excited if you got another 15, 20 basis points? I think so. Could you add a little bit here? I think so. The front end of the yield curve, I still think is too high. I still think we got to price more out of the Fed moving in March. I think we have to price a bit more out of how many cuts the markets are anticipating for this year. But I think in that belly of the curve, you're getting, would you start to put some money to work here? Yeah, I think you could put a little bit of money to work here.
Okay, on credit, I've had lots of opinions. It's priced to perfection. IG over high yield is where people want to be. Given this trajectory that we're on at the moment, perhaps delayed rate cuts, a quasi-soft landing, what does that do to credit? You want to see a little bit, I mean, $250 million was wiped off credit this week alone in 2 days. So we've taken a chunk out of credit. Do you expect it to back up further? Are there better re-entry points in credit?
So there's a lot of supply that's going to get, by the way, US, Europe, we're pricing a lot of supply in the market. Market needs to digest that. You push back a little bit. I think if you step back, these spread levels, sexy, not really. But I think people are what they're going to realize for 2024, if we can create a portfolio using credit, using mortgages, using some securitized assets, if you can create a yield of 6 to 6.5 using the risk-free rate, some credit, some securitized, some mortgages, some high-quality assets, let's say you can build a portfolio of 6, 6.5. If the economy is moderating to 1.5 real GDP, 2.5 inflation, you can clip 6, 6.5. That is really, in an environment, what's my return going to be in 24? If I can get a 6, 6.5, maybe a little bit higher in fixed income, marry that to equities. So would I buy some credit? Yeah, I'd buy some credit through the indigestion of the supply that's coming, and just try and build this portfolio that gets you, gets you a 6, 6.5 yield. That's pretty good in an environment with an economy that's slow and an inflation that's coming down, and a Fed that'll get to that long-term funds target. Boy, if you can clip 6, 6.5, pretty good.
I'm on my way. I'm coming out of those things that they've told me now what CDs are in this country. I'm on my way. I'm looking for the Rick Reader, the retail fund, a little touch of that. Let's just close it off. I mean, give me your opinion. I was surprised you say we have 17 trillion in cash assets across the market in money market funds. Now, to a certain extent, you're going to speak your own book, aren't you, Rick? In that it's going to be the bond market that picks up that. But is it that those yields, the structure of those yields you've just outlined to me, is a better return relative to the risk in equity?
So this is not the most profound answer you're ever going to get. I think that some of that money will come into equities. I actually think the technicals in the equity market, I think are terrific. We're getting huge amounts of treasury supply. We're getting some credit supply coming in fixed income. I still think there's some equities that make a bunch of sense. I've been buying some in the last few days. There's some equities you could buy that trade at 3 times cash flow, 7 to 10 times earnings. That you look at energy, you look at autos, you look at airlines, you can look at casinos. There's some equities to buy. We could talk a lot about the Magnificent Seven. I think equities will get some of that money, and so my answer would be I think money will continue to flow into fixed income, and you're seeing that at the beginning of this year. You saw a lot of the quote unquote January effect happen in November and December. But I think you're going to see that money come in. But I also think people underestimate, you don't have your big equity buybacks, you don't have a lot of IPO calendar in equities, and I think it'll support the equity market. My net conclusion is if I can get 6 to 7 in fixed income, I think equities aren't going to have the returns I had last year. But if companies can throw off in an economy like this 10%, 8 to 12% ROE, then boy, I'd take some equities too, and so build a balanced portfolio that I think will work in 2024. Not spectacular equity-like returns in tech AI, but pretty good numbers.
Hey, what's not to love about 6.5%? Rick, thank you very much, Rick Reader, there with the very latest response to this non-farm payrolls. Joining me now on set to look at the stocks ahead of that opening bed, it is Katie Greifeld. Katie, how are you?
I'm pretty good, Manus. Let's talk about Tesla because it's slightly lower pre-market. That's after recalling 1.6 million cars in China. That amounts to virtually every car it's sold in the country. That recall due to issue with its autopilot system that increases the risk of crashes. You can see shares down slightly. Let's talk about Apple too because that bad week isn't getting any better. Of course, we had downgrades from Barclays and Piper Sandler dealing a 1-2 punch this week. Still sinking pre-market just a little bit, but still on track for its worst week since September. And really quickly, let's talk about NVIDIA. No real news here other than it's getting its mojo back. It had a rocky start to 2024. It put together a gain yesterday. It's doing the same today, Manus.
Okay, let's see how the cash opens a little bit later on. Katie, thank you very much. Coming up on the show, Republicans taking shots at Bidenomics.
The way we get the economy back on track is to first acknowledge that there is a spending problem in D.C. And it's not a Republican problem or a Democrat problem. Both of them did that to us.
The economy and politics, the conversation. That's next with iCapital's Anastasia Amoroso and PGIM's Michael Collins.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
We need to get interest rates down. The reason why we have high interest rates is because government has borrowed, printed, and spent ungodly sums of money starting in March of 2020. Both parties are responsible for it, and that has driven the interest rates up.
The way we get the economy back on track is to first acknowledge that there is a spending problem in D.C. And it's not a Republican problem or a Democrat problem. Both of them did that to us.
The GOP presidential candidates there, Ron DeSantis, Nikki Haley, weighing in on the U.S. economy in the CNN town halls. Now, both facing off in Iowa in a debate next week as they compete for the GOP nomination against the frontrunner, Donald Trump. Trump, once again, declining counter-programming with Fox Town Hall for his own narrative. Now, this is the latest payrolls report coming in hotter than expected, giving President Biden a boost in theory as he's set to speak on the campaign trail near Philadelphia today, Haley's home state of South Carolina on Monday. The jobs report, 216,000. The estimate was 173. Katie Lyons joins us now. Will this give Biden a trump card? I couldn't resist the pun.
Well, Manus, you were exactly right in saying it should help him in theory, because yes, the president is very likely to flex this data. He likes to tout how many months in a row the unemployment rate has remained below 4%. This month makes 23. The fact that wages are now outpacing inflation and that the unemployment rate and job creation figures are just working for him, again, theoretically. When you look at the polls, though, his economic approval rating remains quite low. He has really struggled to get credit for it. And as he campaigns for re-election, that is a problem for him. And that is one of the reasons why perhaps you are seeing that that former President Trump actually is leading him in many national polls. Of course, Trump is also leading by a long shot the Republican primary race, and that remains true as we are now just 10 days out from the first real state contest in that race. The Iowa caucuses are coming up next Monday. Trump holds a lead. He's above 50% in most polls there, while Nikki Haley and Ron DeSantis are roughly neck and neck in the high teens. So that is why they were trying to make their cases in that CNN town hall last night. It was really interesting, Manis, to see them not so much go after each other as they really have been for this entire campaign, but to more directly go after the frontrunner in Donald Trump. Nikki Haley was talking about how chaos follows him and the country won't be able to stand another 4 years of chaos. And Ron DeSantis actually went after him on specific policy, from the border to spending to even the issue of abortion. So clearly they are trying to cement their place as number two, as it is highly likely that Trump is going to win in Iowa. But of course, we're all waiting to see if a real contest can happen after that, Manis.
Yeah, Kelly, I think you've summed it up, which is, which of the two of them can put their stake in the ground as a credible alternative against Trump on the ticket. Kelly, thank you very much. Kelly Lyons, getting ready to go on the campaign trail. Joining me now to discuss the markets and politics, it's iCapital's Anastasia Amoroso and PGIM's Michael Collins. Good to have you both with us. Here we are, a hot report, 216,000 jobs, wages are rising. This should, in theory, play well for Biden. Anastasia, he needs this because he's lagging in the polls. How does it play out? Good morning.
Well, good morning to you, Manis. I mean, obviously, it is positive news for the economy and therefore for the president that we got today. I mean, you're absolutely right. The jobs report was absolutely hotter across the board, whether you look at wages that were higher, than expected, whether you look at the number of jobs created, and of course, the unemployment rate at 3.7%. So that's definitely good news for the administration, for the economy, I think for anybody in the jobs market. But from a market perspective, of course, we're concerned about what does this mean for the Fed. And I think the very initial interpretation is, well, that likely means that the Fed does not actually cut rates. But I think that's a premature conclusion because, Manis, there's a lot of other developments on the macro front that we got this week that, to me, actually suggest that there is a rebalancing happening in the labor market. For example, the job openings number has actually come down to 8.8 million from the peak of 12. We also got the ISM prices paid index that declined more than expected. So you put that together with the inflation print that we're likely to get next week at 3.8%, core CPI. I think that also shows you that inflation may actually be coming down. So you put two and two together, good for the administration. I actually think good for the Fed and rate cuts as well.
Okay, so that's a slightly contrarian call in terms of good for the rate cuts. Mike, let's take it across to you. Look, you say this jobs market will slow down, and that will come, but this data is not helping your prognosis. I want to get a feel for how much this early innings of still strong job growth is going to play out in Washington and around the country. Is it just too early for wages to matter at the polls? Is it too early for job creation to really matter at the polls?
It's actually remarkable, Manis, that that Biden's approval ratings are so low when you actually have had a really strong economy, a super strong labor market, really strong financial markets, and still, not seeing any love from voters there. We'll see what plays out later this year. But you are, in fact, seeing a clear deceleration in the labor market. We were growing at over 400,000 jobs a month last year, or in 2022. In 2023, that got cut in half to just over 200,000, which is consistent with the number we just saw for December. And I would argue by the end of 2024, we're going to be running at a monthly rate of jobs growth of, closer to 100,000, which a lot of people would argue is kind of a neutral state, consistent with the demographic growth. So it is decelerating, right? It's in the numbers, but it hasn't fallen off a cliff. And our base case is that it doesn't, that you just have a natural deceleration in the economy. I mean, our economy grew, close to 2.5% in 2023. That's actually probably higher than our potential growth rate. So in 2024, growth is going to probably be in the mid-ones. There's nothing wrong with that. That's actually not much lower than the average real growth rate for the last 6 years or so. So I think we're just getting back to a more normal pace of growth, which is a little bit slower, and that I think is fine for the Fed. It's fine for financial markets.
Look, we're coming off 10 years of zero rates, so we're all beginning to understand what it is to actually pay a mortgage at 5, 6, 7%. So it is about a unique environment that is migrating. Anastasia stays with us, along with Mike, Anastasia Amoroso, and Mike Collins. My guest this morning dissecting the jobs reports and where you want to place your bets. Coming up, we've got morning calls for you. It is Jobs Day in the USA. Technically 216,000. Is that hot for you? We can revisit that conversation. We'll keep it going with iCapital's Anastasia Amoroso and PGM's Michael Collins right here on Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
This is Countdown to the Open. I'm Manus Crenny in for Jonathan Farrow. We're actually coming off the lows on equities. The sentiment out there seems to be focused more on the wages. It's a strong consumer rather than the risk of less rate cuts. Let's get across to some of the morning calls now and the recommendations. First up, BTIG downgrading PayPal to neutral, saying the company faces too much uncertainty in 24. Up next, Wells Fargo upgrading Carnival to overweight, seeing upside growth surprises and improving fundamentals. Finally, Truist downgrading Zions Bancorp to hold, expecting muted loan growth, higher expenses. It's going to weigh in the results. Coming up on the show, it is the opening bell with more from iCapital's Anastasia Amoroso, PGM's Michael Collins. First take and reaction on asset allocation on Jobs Day in the USA.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Counting down to the cash open, there's a nice break of trend. The consumer could remain strong because wages are rising. This is a break of trend in the SPOOs. NASDAQ also breaking its force. Have we reached the top? Rick Reader says that in these bond markets, it's actually looking like a nice entry point. So the consumer is strong. Let's see where the cash turns to. Green on your SPOOs, on your NASDAQ. As for the broadening and breadth on trade there, as you can see, up, well, there you go. Russell is just moving to flat at the moment. Euro dollar. Now, we've had 6 days of strength on the dollar. So it depends how you view this risk move. Could it be a bit of a turnaround? 10-year yields 4.04, just up 4 bips at the moment on 10-year government bond yields. We've just had BlackRock. You want to find a nice high diving board to jump off and go long, and this is an appropriate time to pick up bonds. Crude up by 2.125%. There's an inventory story there, a bit of a draw, but also geopolitics playing in to the crude oil market, up 2.25% as we go home for the weekend. One stock to watch. I don't have a Peloton, but the shares are extending their advance amid residual optimism over the partnership with, you got it, TikTok. Katie Greifeld, take it away.
Peloton shares riding high. The pun was right there, Manus, and that's certainly what we're seeing today because traders clearly excited about this deal with TikTok, which will create a co-branded hub, which of course will feature Peloton content that will include select live classes, instructor series, and celebrity collaborations, rather, hard word to say there. We know it's been a rocky road for Peloton. Remember 2020, best year ever, shares up over 400% that year alone, but it's really struggled post-pandemic as people ventured outside, they went back to the gym. They're trying to turn the ship around, though. In addition to this TikTok deal, remember that Peloton also partnered with Lululemon and sports organizations to really help boost revenue and boost engagement. CEO Barry McCarthy expects that will start to bear fruit in the second half of the fiscal year, which ends in June. So we'll see if that's the case, but shares currently up about almost 6%, and that's on top of yesterday's nearly 14% gain, Manus.
Okay, Katie, thank you very much. Let's turn our attention to the earnings slate. Constellation Brands succeeding Wall Street's expectations, or even exceeding Wall Street's expectations. They've got a beat on the profit. Despite the soft guidance, what does it mean? How did the market take the divergence? Simone, what have we got?
Yeah, Manus, the shares up so far this morning, despite a pretty muddled earnings picture here. Constellation, of course, is the maker of Corona, Modelo beer, also makes wines, including Robert Mondavi, Kim Crawford, and a handful of spirits. So these results were for the quarter ended November 30th. Earnings per share roughly came in line, but net sales slightly shy of what analysts were anticipating. They were up, though, on a year-on-year basis, but their outlook was pretty mixed. Be able to reiterate their comparable sales or comparable earnings per share forecast for the fiscal year, which ends in February. But the real strength here is all in the beer and not so much in the wine and spirits. You may remember Modelo became the best-selling U.S. beer after the Bud Light controversy last year, and shipment volume there was up 3.5%, slightly shy of what analysts anticipated. However, when you look at shipment volume of wine and spirits, down 11.6%. It was supposed to be down just over 1%. If you're bullish on this, according to Vital Knowledge, you say, well, 84% of the company's revenue was due to beer, and so that offsets any of the weakness in the other segments. But if you're bearish, you look at that and say that cannot be ignored, that wine and spirits segment. We're going to be listening for commentary around that on the call later this morning, Manus.
Yeah, certainly things are looking very frisky. You look at some of those big European brands, Pernod Ricard down 4%, Remy Cointreau all down 12%. This is on an anti-dumping probe, but no permutation into the U.S. stocks so far. Simone, thank you very much. Wrapping up the numbers there. Automakers, Tesla, recalling more than 1.5 million cars in China due to autopilot issues, increasing the risk of accidents. Ed Ludlow is in San Francisco. Look, it's never good when you've got a recall. The question is the gravity of it and the size. So contextualize that for me.
Yeah, the reality is that it is a recall in name only. The concern of China's regulator is that Tesla is not doing enough to draw the driver's attention to the rules of the road. And in using autopilot, the regulator is concerned that there will be misuse that could result in accidents. The solution is an over-the-air software update. It's not as if the regulator is forcing Tesla to take back physical possession of the cars. 1.6 million vehicles in China impacted, as you said. Those are for domestically or locally built Model 3 and Y from 2014 through to the end of last year, and also any imported Model S and X within the same time period. And it mirrors really closely what happened last month in the US, right, with NHTSA. That was, again, a recall in name only, where the solution was a software update. You can do it at the press of a button overnight very quickly if you're a Tesla owner. But the stock is under pressure. We're down for a sixth straight session, matching the run of declines that Tesla had in August. The stock's trading at its lowest level since November. It's on track for its biggest weekly decline since October of 2023. It is down for a third straight week. So, again, a recall in name only, but it seems to be pressuring the shares. We're down 0.6% in this Friday session, and it's part of a sort of news cycle that has seen Tesla under a bit of pressure of late.
Ed, thank you very much. Succinct wrap up there. Let's stick with the tech theme. Apple shares off their weakest start since 2019. As Foxconn adds growing iPhone concerns. Alex Semenova joins me now with a little bit more. It's been a tough old week for Apple between downgrades and various issues. So fill me in on the latest.
Definitely, Manus. So Apple probably finally starting to recover from its New Year hangover today. Shares moving slightly higher into the open. That's after it gave back some of its blockbuster 48% gain from last year to start 2024. Shares seem to be on the mend here after falling for 4 consecutive trading sessions. After earlier this week, at least 2 brokers downgraded the stock, citing weakening iPhone demand. This morning, Foxconn also said that it sees sales falling for the current period. Foxconn is Apple's foremost assembly partner for its iPhones, and as such, provides insight into demand for the iPhones and other personal tech items. Shares were down 5.5% this year. As of yesterday's close, that wiped out $160 billion from its market cap. That also sent the stock into oversold territory yesterday, and those losses came after downgrades from Barclays and Piper Sandler. They cited weakening iPhone demand and concerns over the macro environment in China. Apple's woes also come amid bigger concerns over the Magnificent Seven stocks that powered the market last year. Wall Street concerned that those shares may lose some of their luster in 2024. Apple was already the least loved stock heading into 2024, with the lowest number of bullish recommendations from analysts. Manus?
Underloved, but not underowned. There you go. Alex, thank you very much with the very latest. Anastasia Amorosa and Micah Collins are my guests this morning. Okay, so here we are. We've got a couple of narratives. Bonds are off their pop. They had a bit of a pop and a spike. 10-year paper got up to 409.71. I'm sure out there somebody paid 410. So let's just start the conversation there. Is 410 attractive enough first of all, for you, Anastasia, is it a high enough jumping off point for you, as Rick Reeder said at BlackRock? Is that diving board high enough to tempt you in?
I think it's getting into buying territory, Manus, on a 10-year. And I say that because when you look at some of the fair value estimates for the 10-year Treasury, really it's a function of a few things, which is growth, which is inflation expectations, and central bank policy. And what we really had a repricing of right now is not so much inflation or growth, but the central bank policy expectations. And that's what pushed the 10-year back to that 408 level. So now that we are kind of, once again coinciding with a fair value territory on a 10-year, it is tempting to be adding duration. Is it a screaming buy? No, probably not. But I think Rick's point is well taken, is as we do get these pops in yields, investors do want to buy those, because keeping the eyes on the prize, so to speak, if we are going into an environment where the Fed is going to be cutting rates this year, then the 10-year Treasury yield should fall, the 2-year should fall, and really all sorts of fixed income should do well as a result of those yields falling. So I do think you want to buy those spikes in yields.
Give me a level on the dip in the 10s, and then I'm going to move to Mike. If you make a call, you make a price.
I mean, I think anywhere between 4.1, where we are today, to 4.4 is really an interesting buying territory. That's what I would go with.
Okay. Mike, let me take it across to you. Here's the debate that I'm having on the IB at the moment. Are you a coupon clipper on the T-bills, or are you a duration-hungry bond trader?
Yeah, I think in general, Manus, over the intermediate term, the next few years, investors are supposed to be looking for opportunities to add duration, right? I mean, there's so much empirical evidence going back to many different cycles. When the yield curve gets flat or inverted like it is today, you're actually supposed to move away from T-bills out and add duration. And sure enough, that actually did work in 2023. It's just that it didn't work until the last 2 months of the year. But we're actually betting that over the next few years that you're supposed to leg into duration. I mean, we did cut some duration on that huge rally into the end of the year. I think it was a little overdone in the near term. The Fed rate cuts that were priced in were too aggressive in the near term. Those are paring back a little bit. And similar to what Rick Reeder, I hate to be consensus, but similar to what Rick and Anastasia are saying, you're supposed to buy on the dips in rates. You get any backup kind of into the 4s, 4 to 4.5. I'll put a bigger range on it. Investors are supposed to be adding duration there.
Far be it from me. The reason why I left being a broker and left being an advisor is because, I'm the biggest contrarian trade in the world. So, consensus was a little bit off last year. There's nothing wrong with jumping in with consensus this year. We're having this great debate about breadth and dispersion, and this is the year that we're going to go for breadth. Is that part of your narrative, Mike? I mean, you look at the turnaround. The NASDAQ had a little bit of I would just say, a moment of realization. I call that healthy. So are you in for broadening the reach, or do you think I should stay at the top, stay with the 7, stay with the strong, the balance sheets, stay with the innovation?
I'm a deep value contrarian investor as well, Manus, and it can be painful, and we're typically contrarians, we're typically early, but I like the value story more broadly across the stock market, away from the big, high-flying tech stocks. I think the smaller caps, the value side is fair value, if not a little bit cheap. Obviously, you're seeing the Russell 2000, the small cap index, really trade in line with rates, right? If the markets are pricing lower rates, a more dovish Fed, that's really bullish, because those companies tend to be more correlated with the high yield market. They tend to be a little more levered to the economy, a little more levered to interest rates. So I think an easing in financial conditions, lower rates as we go through the year, the Fed cutting rates will support those more undervalued parts of the market.
Now, of course, Anastasia, you make the point very, very clearly, which is tech alone is not, big tech alone is not going to save me. It's not going to make or break me either, but you do want to broaden the church, so to speak. I want Nancy Tangler this morning saying, you just want to buy Apple on the dip, stack it away, say 5 years later, this thing will throw off dividends. But for you, it is about owning more than just tech. So what do you want to own apart from big tech?
That's right. And first of all, I don't think big tech is a sell necessarily. I do think that if you do have cash to deploy in money markets, and as we know, there's 1.4 trillion that went into U.S. money markets last year. If you're looking for places to deploy that, I think there's a lot of them. So I do look like some of those value trades and some of those contrarian trades that didn't perform well last year. So there's a whole host of them. Some of them are value, some of them are growth that's still trading at a discount. So I do think if the central banks around the world, and the U.S. certainly cut rates, then that bodes well for leverage and lowering the cost of it. And that means that smaller companies can perform better. That means real estate companies can perform better. And so I would be looking for pockets of opportunity in places like real estate, and frankly, in just the equal weight index of the S&P 500, because there's a lot of companies there that will benefit as a result of lower cost of leverage. But on the same, by the same token, I also do want to have some growth that maybe didn't perform so well last year, and that's smaller cap growth. So think cybersecurity stocks, think all sorts of unprofitable technology positions that should benefit from better sentiment due to lower rates.
Okay, Anastasia and Mike, you're sticking around. We're not done with you yet. Coming up on the show, Investors Digest, the latest jobs report.
So the last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force. And I think that this just reinforces that.
Now we look ahead to next week's big inflation print. That conversation next on Bloomberg.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
What does it take to be a great surgeon?
This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force. And I think that this just reinforces that. The economy is still doing pretty well. Looks like we're going to have growth in the fourth quarter of 2% plus. Financial conditions have eased a lot over the last couple of months. So I think that risks are that the Fed's going to keep rates higher for longer.
Strong payrolls number reports dimming the prospect that the Fed will lower interest rates anytime soon, specifically March. Now, 50-50 towing course. Coming ahead of the big inflation print next week, the headline number is expected to edge higher. That's amid rising gasoline prices. For more, we've brought Bloomberg's Mike McKee back into the studio. So you've had a little bit of time now to digest this. Strong numbers, strong wages, but you say this is a challenge to get everybody to meet in the middle. What do you mean by that, Mike?
Well, basically, we know the Fed and the markets are essentially married to each other, but they're not sleeping in the same bedroom these days. They're not even sleeping in the same house. They're neighborhoods apart in terms of what they think is going to happen to the Fed funds rate. You see the Fed, they're thinking about a median number of 3 rate cuts, and the market's still pricing in between 5 and 6 even after the jobs report today. So something's got to give at this point. And the question is, when does it give and how much? Next week, we get the CPI report you mentioned, and basically just because of base effects, it's the headline number is going to go up. So how do markets react to that? The Fed also has a PCE report before their next meeting, and fourth quarter employment costs, which could be affected by the average hourly earnings number that went up today to 4.1%. And then before they get to the March meeting, they've got 2 more payroll reports, 2 more CPI reports, another PCE report, and then the Fed meeting on March 20th. We went into this week thinking that the Fed was going to cut rates, or market did rather, thinking there was a 90% chance the Fed would be cutting in March. That's down to 60% now. And by the end of the year, we're down to just 5 cuts. It would be 6 if you get to January of next year. Now, here's a chart I want to point out to people, too, because this is a big part of the debate, is financial conditions have eased. But these financial condition indexes are basically reflecting what's happening in the markets, not necessarily what's actually happening in the credit world. As you can see, the price of money for cars and homes and the prime rate for businesses and credit card rates have barely gone down. So we're not seeing the kind of loosening in financial conditions that people are thinking we should be seeing because of the drop in the financial conditions indexes. So the Fed still has some tightness that they could take away if they want.
Okay, I think that's certainly one to reflect on, the difference between FCON and reality. Mike McKee with the very latest analysis of the jobs report. Anastasia Amoroso and Michael Collins are with me as guests this morning. I mean, there is a thought for us just to close off on, which is that long variable lag could yet arrive if you look at the differential between FCON, which is obviously very louche and it has eased considerably, versus reality in the economy. Mike, are you banking on that?
Yeah, I think it's really a tale of 2 economies here, right? The people who have assets to invest, the people who own houses, the people who have locked in low mortgage rates are really benefiting from the environment today. But a huge percentage of the population, man, is in the U.S. and globally are subjected, as you pointed out, to those tightening financial conditions, and they do chip away over time. And I think that's one of the reasons our view is that you will see weakness in lower middle income consumers. You're seeing that already. You're seeing consumers trading down pretty significantly across a whole range of different industries. You'll continue to see that bite. You'll continue to see growth on the margin slowing down as a result of those higher interest rates.
Yeah, we're just coming out into a very unique new paradigm. Anastasia, I mean, we've been fairly bullish on good jobs report, wages rising, stocks are off their lows. You know, it's quite halcyon in many ways. But you warn that there are spoiler alerts out there, and one of those is the size of government debt. So is that, I mean, this was an obsession by the bond market before we went off for Christmas, wasn't it?
Yeah, it was. And Manus, that's one of the reasons why I was saying that this is probably not the last spike in yields that we see, because as we progress through the year, we have to deal with greater sizes of Treasury auctions. And we, of course, have the quarterly refunding announcement that's coming up at the end of the month. We're expecting the size of Treasury issuance to be up 22% this year as well. And there will be periods potentially of a market indigestion that could cause those spikes in yields. But once again, I think investors should be looking to buy those. And then the other thing that I worry about somewhat is that you know, you do have the size of debt pile, whether it's the government, whether it's the commercial real estate, whether it's maybe pockets of private credit, they do have to shoulder the burden of higher rates, whether it's the floating rate rates or through refinancing the upcoming maturities. But when I take a step back and I look at the size of them and what levers they have to pull to deal with that, I think those risks are not systemic, and I think they are manageable.
Okay, manageable risks and things really not as bleak on the jobs front as we anticipated going into this. Anastasia, thank you very much. Anastasia Amoroso and Mike Collins on the markets. We've turned it around. We're in the green on the equities. The jobs built by 216,000, quite a bit ahead of the estimates at 175,000. S&P futures trade up 0.2%, and NASDAQ up 0.25%, bouncing from the lows. Coming up, the market moving events that you need to watch out for. That's next in our trading diary.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
What do you need to keep an eye on for the next week? This is your trading diary. This is what the agenda is. ISM Services coming in at the top of the hour. The Atlanta Fed President Raphael Bostic speaking next Monday. More Fed speak. New York Fed President John Williams on Wednesday. Plus, it's the deadline for the SEC to vote on the Bitcoin ETF applications. Thursday, CPI. That will define the next bond move for you, along with the jobless claims. And we round out the week with big bank earnings kicking off. Statement from the President of the United States, Joe Biden, at the White House, saying workers' wages and wealth is now higher than before the pandemic. Prices are coming down on gas, milk, toys, and airfares. That's it from me for this week. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We got some green on the screen here. Coming up, we're going to check in with Anna Wong. She is the chief U.S. economist for Bloomberg Economics. I want to get her thoughts on the labor data today. Plus, I want her 2024 GDP outlook for the U.S. And then Ben Emmons, head of fixed income at New Edge Wealth. He's going to join us in studio to give us his market call here. Jobs breakdown. Who are we going to do that with? How about Haley Dam, vice president at Adecco, to get her thoughts on this jobs data. Jobs came in better than expected. Wages higher. Solid labor market out there. So we're going to break that down going forward. Let's kick things off, though, with Nathan Hager down in D.C. with the Bloomberg Business Flash.
Well, the services data just came in weaker than expected. Paul will tell you more about that in just a second. First, I'll tell you this Bloomberg Business Flash is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. The Institute for Supply Management's services gauge fell 2.1 points, getting close to stagnation at 50.6. That was below all analyst estimates. A lot of the focus, as you mentioned, remains on the strong jobs report. 216,000 new payrolls added in December, and the unemployment rate unchanged at 3.7%. Alan Ruskin, chief international strategist at Deutsche Bank, says if the data keep coming in this strong on the labor market, everybody's going to have to rethink their bets on Fed rate cuts.
I think the Fed's bias has still been, it's in the very short term, they could still hike rates. That could still come back on the table. I think, that's leaping ahead a long way, but certainly taking back rate cuts is a relatively easy call. In terms of March, I think looks, that 2/3 probability of a rate cut that we had effectively before this data looks exaggerated.
And you can hear more from Deutsche Bank's Alan Ruskin on the Bloomberg Surveillance podcast. Looking at the markets, stocks are moving higher. The S&P is up 23 points or 0.5%. 4712 is the S&P level. Dow Jones Industrial Average up 127 points or about 1/3% at 37,571. The NASDAQ Composite up 71 points, up about 0.5%, trading at 14,583. The 10-year Treasury is now up 5/32. The yield below 4% now at 3.97. NYMEX crude is up 2.7% now at $74.16 per barrel. COMEX gold is up 0.7% now trading at 2,065 even per ounce. The euro stronger against the dollar, 1.0987, and the yen is at 144.27. Change in the market now, and Bloomberg Markets is on now with Paul Sweeney and Lisa Mateo.
Yeah, Nathan Hager, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube. So you can head over to that internet thing, youtube.com, and search Bloomberg Radio. Lisa Mateo joining us in studio for the next 3 hours. Welcome.
Good morning. Great to be here.
I mean, Lisa Mateo, if you're in the New York metro area, you've seen Lisa for years. She's been on Channel 11, PIX. She's been on radio, TV, all throughout the New York market. She's been with Bloomberg now for how long?
Going on over 2 years.
Over 2 years, doing a lot of radio stuff for us. We said, let's just get her in studio, please. I mean, we need some help here, that's for sure. So Lisa Mateo giving us 3 hours today. We appreciate that.
Buckle in.
Exactly. Hey, Nathan Hager is just reporting on that weaker than expected ISM services data. Came in at 50.6. The street was looking for 52.5. So we're seeing a pickup in the market here on that weaker than expected services data. So interesting to keep on top of that. Nora Melinda joins us here in our Bloomberg Interactive Broker studio to give us a sense of what's happening out there in those markets in this early trading. Nora, what are you looking at?
Right, so I'm keeping an eye on Apple. While it's up only about as much as 0.5%, this gain may seem small, but it's really an important stock to watch today. Apple is off to its weakest start to a year since 2019. It's fallen every session this week to start the year, after rallying 50% to end 2023. That slump is putting Apple's longstanding status as the world's most valuable stock by market value in jeopardy. The company has been the most valuable publicly listed company since July 2022, but its shares have fallen sharply this year after the tech giant was hit by 2 back-to-back ratings downgrades by analysts who are flagging weak macro dynamics in China that's pressuring demand for iPhones over there. The fallout has shrunk its lead over its fellow tech giant, Microsoft, to less than $100 billion.
Wow. I mean, we just had Anurag Rana on. He's a Bloomberg Intelligence. He's a tech analyst. I mean, he's saying China's an issue. And if you look at the FA function on the Bloomberg terminal, which gives you kind of looks at the income statements, the balance sheets for all the securities out there. It's like our most widely used function. It's kind of got revenue growth forecasted by the street for like low to mid single digits. That's kind of it for this name. And if you're comfortable paying a 30 times multiple for that, that's what you're doing if you're an Apple investor.
And they had some more bad news today. Foxconn, that actually reported 20% drop in December sales.
Oh.
So that's not a good sign.
Not some good signs right now. Not some good signs.
I don't know, but I don't know. I buy weakness. I buy Apple on the weakness all day long. Who's kidding who?
On to another one. We've got Medical Properties Trust. That's right in my alley. I cover REITs, all things real estate. But Medical Properties Trust, that's a healthcare REIT, is down as much as 32% in trading today. It's plunging for its biggest drop on record and lowest level since March of 2009. Now, that's because it said that it plans to accelerate its efforts to recover uncollected rents and outstanding loan obligations from Steward Healthcare System. So total unpaid rent is about $50 million. As of December of 2023, and while Medical Properties has agreed to fund a new $60 million bridge loan to Steward's ABL lenders, investors are really worried.
But healthcare REITs healthcare office REITs, those are good investments, right? I see doctors'
Depends on who
offices
you
everywhere.
ask. Depends on who you ask. I mean, of course, commercial real estate as a whole has been a really troubled space all through last year and prior leading into it. So I do think when it comes to REITs, the first to be sold off are office REITs and, a lot of those commercial real estate names. But this is a really interesting sector, specifically with Medical Properties Trust.
I don't know. In New Jersey, the Summit Medical Group has taken over the state. Their offices are everywhere. I remember when they were just some little building on the corner in Summit, New Jersey. Now they're everywhere in New Jersey.
Everywhere.
Yes. All right. Next name is the one I really want to talk about.
Great.
What do you got for me?
Peloton. It's
All right.
up as much as 7.5%. It's since paired a little bit. I think it's around 2.5 right now, but it's soaring on residual optimism over its new partnership with TikTok. It's hoping to create a fitness hub on the TikTok app and tap into a new pool of potential customers. Now, this agreement marks the first time that Peloton will produce custom social content for a partner outside of its network. And the new product should include celebrities, select live classes, and apparently some opportunities to work out with or without equipment.
I don't know. I mean, Lisa, you're a crazy workout
Right, you're the
fanatic,
one.
right, Lisa? That's your.
It is.
You're a crazy workout
I'm a
person.
crazy workout person, not a Peloton fan. But here's the thing. I mean, they've been doing these partnerships, right? They partner with Lululemon. They've been trying like tiered memberships. Do you do the Peloton, Paul? You have the bike,
Dude,
don't
I
you?
am all in. I got
He is.
I
have
got
the bike? Okay.
the bike and the treadmill. It's not me.
Oh,
It's
my goodness.
It's my better half. But
So
I'm
would
on
you do
though.
it on TikTok?
No.
I didn't think so.
Well, are you on TikTok?
Of course not. I'm a professional.
The leading question.
I mean,
that's what you're saying, like the
the
Gen Z.
demo.
Right.
I just learned yesterday the demo for TikTok is like 12 to 24. That's the demo.
Wow.
Like my twins aren't even. They're 27. They're not on TikTok.
The more you know.
Yes, exactly. So, but Peloton. This story on Peloton is not the TikTok thing. Peloton instructor Jen Sherman, my gal, my favorite instructor, she complained in a 2020 class that she had that a Christopher Nolan movie was a waste of time.
Oh yes.
He just took that class like recently, and they've been going back and forth. And
He said it was brutal.
Yes.
Like it was hard.
Yes.
Is it?
Yeah, and she complained that his movie was terrible, and then he took it. Now they're going back and forth, but now I think they're buddy, and it's all good. But that's the Peloton news I know. But the Peloton is for me is the classic pandemic stock. I mean, it just ripped when people were locked inside and they were buying these Pelotons. They couldn't sell them fast enough. Quite frankly, they couldn't make them fast enough, and then it's come right back down.
I mean, it finished.
People are going back to the gym though.
Yep,
I mean,
exactly.
maybe they're going back in person. I mean, the stock was finished 2023 down as 23%.
Yeah, it's been a crazy thing there, but some good stuff going on out there in the marketplace. Nora Melinda, she covers all the equity stuff for Bloomberg News. We appreciate getting a couple minutes of her time. We had Lisa, the stuff today. It's all